Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's July 18th, 2019, episode 37. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week. Today we are joined by Rob Koyfman, who will talk macro and walk us through his trading platform, Koyfin.com. For our WTF segment, we get a bold forecast.
And for this week in trading history, remember the Russian ruble crisis, and we get to the top 5 things to watch this week.
Okay, Patrick, before we start, we got to give a big reminder. We're getting close. July 21st in Chicago, the big SmackDown. And actually,
I've been warming up.
I know you have. What you do in the bathroom on your own is your own business, Patrick. Don't tell us. For those who don't know, Patrick and I are having a great bond bull bear debate at the Traders Expo with John Netto on July 21st at, I believe we're on at 10:30.
No, 10 to 10:30.
10 to 10:30. So it'd be better if everyone came at 10:30.
It's better. It's better.
Missed our whole thing.
Yeah. If I'm wrong that it starts at 10, then they'll only be a half an hour early. But if they come at 10:30 and it started at 10, then they're going to miss the whole thing.
Yeah. Well, okay. Anyways, 10 to 10:30. But more important than that is at 2 o'clock, we're headed off to the public house at 400 North State Street to drink some beer and to meet the market huddlers. Please come on by. We're going to have some fun. I know that Alex Manzera is already coming. I have some other fellows that are coming.
John Netto's going to be there. A few of the other speakers that are going to be a part of the Macro Edge are going to come out as well. So it's going to be a lot of people. And just a quick thing for our listeners: even if you're not experienced in the markets, don't feel that intimidated. Come on out and say hello to us. That's what that's why we're holding this.
Right, as long as you enjoy beers or talking to people who enjoy beers, that's all that's required. So again, July 21st, that's a Sunday, 2 p.m. it starts. We'll be there probably till 10 o'clock or until Patrick taps out. Anyways, come at any time. We'll be there the whole night. It'll be a lot of fun. Okay,
all right,
let's jump into it. Lena, hop on. Okay, Lena, who's the sponsor this week?
The sponsor this week is Cowbell Brewing Company's Boxing Brewing craft beer that rings true, India Pale Ale.
What an appropriate name.
Okay, I'm starting because I'm dying for a
I've
beer.
been licking the condensation off the beer can for a while. But let me read a little bit.
All right, go for it.
Here. Outrageously hoppy and classically bitter, Boxing Brewing is a true IPA. 5 unique hops and a touch of Belgian candy syrup create a burst of vibrant tropical aromas and flavors of lime, mango, and lychee.
Nice.
The body is smooth with focused bitterness and a refreshing finish.
Okay.
Well, I'll tell you, I just tried it, and for a 6.3% alcohol beer, this is delicious.
Wow.
It's delicious.
Okay, for those who are interested, make sure you stick around at the end where we're going to rate it, and we're not going to get these amateur hour ratings from Patrick and Lena. They're going to give us a true kind of figure skating review.
All right, Kev, give us a legal disclaimer.
Okay, well, actually, before we do the legal disclaimer, we got to go and have a look at the pictures. For those who don't know and are listening to this, our good pal Chase Taylor from Pinecone Macro was kind enough to stick both Patrick and I through this new app that's kind of taking the world by storm that makes you look old.
Yeah.
And so here's the first picture. We see Patrick calling for the correction in Spoos. And then we see Patrick when it finally comes. And he looks like he's, I don't know. You actually don't look that much older, Patrick. Like that's
no,
the thing about
I was saying I look almost better.
So
the double chin sags a little deeper. It's like
you're like a fine wine.
Now, I will say you do remind me a little bit of Ellen.
What? Really?
Yeah. And now, so I'm pretty sure you'd for sure drive a Subaru Outback if in your years later. Now, for me, I have at first glance, you go, "Oh, I don't look that much different. My big bald head, that's all you see." But then you look a little closer, and I look like I've crawled out of a cave.
No, you look like Sean Connery's brother.
Yeah, okay.
Faint eyebrows.
the Sean Connery, the one that was on Jeopardy and swears.
Well, you look much smarter as an older person. I might take you seriously, actually, in your more elder years.
Anyways, a big thanks to Chase, because that was actually terrific. And now that he downloaded that app, which I'm sure is just Russian spyware, he's going to have his phone is going to be compromised. I refuse to put that on my phone. Okay, let me do my legal stuff.
Yeah, do your disclaimer.
Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include never nudity, pop in the attic, and a bad case of TBD. If you experience any of these symptoms, take a forget-me-now and call your analyst therapist, otherwise known as an analrapist, immediately. So Patrick doesn't actually watch Arrested Development.
No, but okay.
But I
watched it. I watched a few episodes. I didn't watch this part. But the funny thing is that you started laughing at yourself before you even put the punchline in. That's like a complete failure as a fucking comedian. Like.
It's funny though. Like it wasn't even. It was one of our, one of our listeners that actually suggested this week's side effects, and I just knew right away that he was a huge Arrested Development fan, and so am I. And Tobias Fuke with his anal rapist, that just anal rapist, he just makes me laugh so hard. And he's a never nude. You know what that means? He doesn't ever get naked, so he wears those jeans shorts everywhere underneath everything. Okay, anyways, we should get on to the actual show.
All right. So joining us now is Rob Koyfman. How you doing, Rob?
I'm doing well. Thanks so much for having me on. This is really exciting.
All right. Well, listen, we're excited to have you on. We're looking forward to you taking us through some of your charts and stuff that you're finding interesting. But are you joining us for a drink today?
I am. We're at a co-working space in WeWork, and WeWork provides free beers. So I'm lucky enough to have a beer here.
What?
I know. I can't believe this. You get free beer. We're in the wrong spot, Patrick.
No guff. Like, okay,
yeah.
so okay. What kind of beer, first of all, are they serving? Is it draft, or is it just bottled beer that they have there?
It's draft. There's a keg on every floor. So there's 5 floors here, and every floor has a keg.
How sweet is that?
Is that a standard, like, WeWork kind of amenity, or is that specific to New York City WeWorks?
I think it's standard, and I think that was like one of the things that they were known for originally. But what's funny is recently they've had to limit the time frame. They basically lock the keg up until 3 p.m. and they only open it after 3 p.m. because I'm guessing people were drinking it throughout the day. So, which is
that's awesome.
That's how millennials do work now.
That's right. Nothing, and it is a true millennial beer. You're drinking Miller High Life, I guess.
I am drinking the champagne of beers, Miller High Life. That's right.
It's free. I mean, you can't complain.
One up from Pabst Blue Ribbon.
Yeah, exactly. And they rotate here, which is pretty cool. So they have different different brewers here, which is pretty cool.
Okay, so let's talk some markets here, Rob. What do you got for us?
Oh man, okay. So I tried to put together a bunch of interesting charts. Kind of try to keep it pretty topical and short. So I think I have like 10 to 12 charts, and a lot of these were created using Koyfman, which is the startup that I started several years ago. And we could go over that later on. But first thing, most important slide, probability of a Fed cut. This is, as you guys know, this is driving all the market action right now in terms of what is the Fed going to do and what are central banks going to do around the world. This is kind of like an interesting way of thinking about the progression of Fed policy over the past 12 months, going from pretty hawkish to pretty dovish, and seeing how the market is pricing future policy. I think one of the most important things is going to be not only the upcoming meeting, and what they're going to say, but I think Jackson Hole is going to be super important because there's a chance, and I think this culmination of speeches over the past 12 months where the Fed members have been discussing ways to measure, or better ways to think about inflation and measure inflation. I think there's a chance that Jackson Hole will introduce this new policy where the Fed will say, hey, we should measure inflation over the last 5 years as a trailing average rather than a point by point basis. And that's going to be a super, super dovish action. And Jackson Hole is typically when the Fed releases kind of new policy, or releases a new way to think about policy. So Jackson Hole, end of August, I think could be a major catalyst for this market.
So are you in the camp that they're going to cut 25 basis points? That's consensus, or do you think that they're going to be bold and go with a 50 basis point cut?
I think they're going to go 25, just because I think there's no just based on where equities are, and based on the mixed economic data. I think 50 is a little too much just based on the facts, but I think it's going to be 25 and then a policy change, or a dovish policy change at the end of August.
But Rob, what you're talking about would actually probably be even more dovish than a 50 basis point cut, in my opinion. Like I agree. I think it's great insight, and I think that a lot of people haven't really put Jackson Hole back on the radar. But as we get closer, it's going to become more and more important. And I agree completely. And I think it's great insight to think that maybe what we're going to see is a change in the Fed's attitude towards inflation, and that might actually drive policy for years to come instead of just in one specific instance.
Yeah, and that's exactly right. And it's sort of thinking about like kind of the duration. Kind of equating it to duration. So I think the Jackson Hole move will be a very long duration kind of policy shift. So my best guess, or central scenarios, they cut 25, they shift policy, and then continue to cut after that. But that's this is obviously a very, very big determinant of what happens to asset prices over the next 1 to 2 years.
Right. So let's talk about why they're cutting in the first place. What do you see in terms of the global economy and the PMIs throughout the world?
Yeah. So, put a chart here of kind of the major PMIs: U.S., U.K., China, Germany. They're obviously at a low. What's interesting though is from a trading perspective, when you have PMIs this low, the kind of the prudent thing, or the risk reward, is for you to kind of look out and say, like, what happens when these PMIs rebound? Because obviously asset prices look forward 6 to 12 months. So to kind of like look at the German PMI or the China's a little bit different because there's a policy issue going on there. But looking at the U.S. and the U.K., it's saying like, hey, PMIs have come down for the past 12 months. I want to be short growth. That's probably not the right way to think about it. What's I think more interesting from my perspective is to think about where PMIs are at the bottom here, thinking that there could be a policy shift to the dovish side, which would boost growth, and then thinking about how you can what kind of trades, or what kind of how assets are going to react to that.
Now, to some extent, equities have already kind of sniffed that out and run ahead, even as bonds have been going up because of the bad economic news. What are you seeing there?
Yeah, so it's interesting. So equities have definitely gone up, but the composition of that, or the driver of that rally, is interesting because it's definitely not led by the cyclicals. So different ways of thinking about cyclicality. So here I just put a basic one, which is industrials performance versus the SPX, which is probably kind of like the most direct way to look at cyclical performance. But you could also use some of the commodity sectors like energy and materials. But the industrials sector versus the SPX, so I'm using the XLI here, is actually trading at a 10-year low relative to the index. So that's the middle chart, the green chart. And that's been declining since for the past 12 months. And so even though the index, the S&P 500, is making new highs, industrials versus the market, industrials versus SPX is actually making new lows. And that's in line with what kind of rates are doing with yields. And so when you look at the chart, you could say, oh my God, that's so bearish. Growth is negative. Market is making new highs. But what I did was I kind of looked back historically, and you could see here, and I'm sorry, the x-axis should have more definition here, but sort of 2011 to 2013, you had a very similar scenario where cyclicals were underperforming, the yields were coming down, and equities were rallying. And same thing happened 2014 to 2016. And basically, when this happens, you have this dynamic where equities are rallying more based on policy and anticipation of policy rather than what's actually happening in the underlying cyclical data. So I think looking at this chart and saying, I'm going to be short equities just because cyclicals are underperforming, I'm not sure if that's the right way to read it, especially given the fact that you've had two previous episodes with QE1 or QE2 and QE3 here, where a similar dynamic has happened and it didn't signal a bear market that was imminent.
And in fact, when we got a situation where industrials actually started to rally versus the market, you actually saw the market struggle.
Yeah. So that becomes really interesting in terms of like that now becomes a more of a relative call or a sector rotation call rather than a, hey, I'm just going to be long equities, because you have this underlying churn where maybe some of the more overvalued names in equities that are levered towards rates are actually going to start underperforming, and cyclicals, which are pretty cheap, start outperforming. But net, the market is sort of just grinding barely higher, moving sideways.
Right. So speaking of some over or too expensive sectors of the market, one of those has got to be the utilities. You have a chart here about the utilities versus the S&P. Why don't you walk us through what you're thinking there?
Yeah, so different ways to think about the utility sector. One is from a valuation basis, which we don't have here. But what's interesting, Matt, it's always interesting to point out divergences because it starts a really fascinating conversation. So here you have this divergence, which I think is pretty interesting, of S&P 500 versus utilities. So this is the relative performance of utilities, but flipped. So when the top chart is going up, the markets outperform utilities. When the top chart is going down, utilities are outperforming. So utilities had been outperforming in 2018 as yields were going down, and they actually stopped outperforming. It's been a sideways trade since the start of the year. And that's happened at the same time as yields have come down. So the yields have come down from 3% to 2%, and utilities have traded sideways. And so my experience with this kind of trade is that the equities are actually tend to be right, or the equities are, all else equal. I would actually say here that I would look for yields to come up, and that the utilities are probably sniffing something out. And sniffing something significant out, but this is a very interesting divergence for me.
Rob, what I want to ask you is because, I understand that utilities have been somewhat underperforming the S&P. I mean, that makes sense what you're showing, but really that's because there was a huge burst in utilities at the start of the year when everyone was piling into these defensive sectors very aggressively. But let's say I put up a chart here on the utilities, just looking at some candle charts here. I mean, this looks like almost like an ascending triangle where we're about to break the 52-week new highs on, let's say, the XLU. And, it's hard pressed for me to say that this looks like a bearish chart. Yes, there's no doubt that the S&P has actually outperformed. But I mean, what's your feeling? Is there still a chance that this isn't over? That maybe utilities can still go for another leg here? Or do you really think this is like a point where those utilities really start to mean revert from this massive rally they had in 2019?
Yeah, I guess it's in the eye of the beholder. So I think that utilities chart, I'm going to argue, is a double top. I'm being a little facetious here. So you're absolutely right. So look, utilities are in an uptrend. Rates over the past medium and long term are in a downtrend or yields. And for kind of like me to call the bottom or the top in both related assets is there's nothing strong here suggesting that. And I really like your point of the sharp utilities outperformance right into year end. So you see that kind of like in the top chart, right heading into that vertical line. You have this really sharp outperformance of utilities, and maybe now they're just consolidating instead of signaling some kind of turn. So definitely take your point. But if so let's say that my thesis is turns out to be the correct one, and obviously there's probabilities associated with it, and we are at the bottom of this PMI cycle, and the Fed and other central banks get more dovish, then you're probably going to have a re-rating of growth and probably higher yields, at least in the short term.
Right.
Yeah. Rob, I like your style. Stick to it. Don't let Patrick tell you about the squiggles and how it's going to go higher. Stick with your short.
Oh, come
bonds,
on. Rob's a squiggles man too, so
I know
don't
he is.
give me that.
Okay, speaking of squiggles, why don't we go to the next chart here? Tech and consumer leading, cyclicals and HC lagging. What are you looking at here?
Yeah, my squiggles are better than your squiggles, right? So you have so here you have kind of like sector performance, and just to the market as we saw is up 20%, I believe, year to date, which is interesting. It's obviously very high relative to history, but also coming off a bottom, so it's impacted by where you start, which is near the market bottom on December 21st. But regardless, where the market equities are doing well year to date. But interesting to kind of think about like what's leading that, and you definitely have this tech consumer leading the market higher, which is important. And kind of important to understand why that's happening. So that's more of a bottom-up story in terms of the companies. I'm not sure if that's a macro story, but it's also a factor story in terms of growth versus value, which we'll cover in a second. So you have here tech, consumer discretionary, and consumer services, three sectors which are clearly leading the market. And you have materials, energy, and healthcare. I'd argue kind of healthcare is more of a policy underperformance, and then materials and energy more of a macro underperformance. So that's just kind of laying out what's driving the market returns year to date.
So let's talk about the technology and what's driving that, because I think the next slide here you talk about Microsoft and Apple being a big component of what we're seeing.
Yeah, so I love looking at this analysis. It's pretty unique analysis that we have on our system, just looking at one command. But it's basically taking an ETF, and so here we're looking at the XLK, and then not only decomposing the constituents, we're decomposing the returns. So when you have an ETF, you have some constituents, you have the weight of each constituent, you have the return of each constituent, and the weight times the return is the attribution. And what's interesting about attribution is it's additive. So when you add up all the attribution, it adds up to the ETF return. So on the top right, you could see there that the ETF, the XOK, is up year to date, is up 30.7%. And then I've boxed in kind of the most interesting observation here, that Microsoft and Apple are responsible for 1,100 bips or 11% of that 30% return. So one third of the tech performance year to date is due to Microsoft and Apple, which is a pretty interesting observation. And again, I think the outperformance there, the performance of Microsoft and Apple, there's some macro to it, but really is a bottom up story or a stock story.
It is worth noting that the two stocks do, like you see it in your middle column there, that they do make up that 36% of the weighting of that. So when you buy the XLK and you put 10,000 in, like literally 3,600 of it is going to just those two stocks. So that obviously is a huge contributor to that, right? But those stocks have definitely been ripping it since. I mean, they did get killed in December, so the year-to-date performance has a pretty good starting point at the beginning of the year. But definitely,
yeah.
So Rob, the next thing I can see that your software can also do subsector of within an index. And walk through, why don't we go to this next chart and show us, just like you kind of zeroed in on the specific returns within an index, you can, of XLK, you can do the same for the broad market as a whole. So what do you have here?
Yeah. So here's a scatter plot of subsectors. And what I'm looking what I put together here is an XY scatter plot. On the x-axis, you have your percent return year to date. So how are the subsectors performing year to date? And on the y-axis, up and down, you see how the sectors are performing over the past 3 months. And kind of the value here is to say, well, what's performing well over the medium term or not well, or what's showing strength and weakness over the medium term, and what's showing strength and weakness over the short term. So let's take gold miners as like an outlier. Gold miners are doing well year to date, but really you could see that they've been outperforming over the past 3 months, over the past kind of short term. And if we look at a candle chart later on of gold miners, we can see that thrust recently of that underperformance. And I've always kind of been interested in things and sectors and stocks and indices that are showing strong momentum and where that momentum is accelerating. And that's definitely an area where momentum is accelerating.
Yeah, so here's the chart on the GDX. But yeah, it's been what a rip. Just the last 2 days, from 26 to 20 and a half. What a move, right?
You know what? I hate to interrupt. And
Go
Rob,
for it.
We're gonna have to take a little moment out here because Patrick and I have a little bit of a wager going on about GDX. No. And I don't want to kind of count my chickens before they I guess what is the saying? Count my what is it? Like
before they've hatched.
Yeah, there we go. Thanks, Luke. No, but the too many beers. But we can go look at the GDX. Patrick, I think that you're having some trouble recently with your gap filling.
Oh yeah. The gap is not filled. You're right. I think that I might have to owe you. What was there a bet?
Yeah, for sure there was a bet.
But what was it? What was it for?
Yeah, it was a big one. I think it was a steak.
Are you kidding me?
No,
I bet you a steak.
Ponied up. Anyways, we shouldn't interrupt Rob. And
sorry.
I made a fool of myself forgetting the saying. I knew the saying, but I thought to myself, chickens, what the hell? Chickens don't hatch, right? Because I was thinking about the eggs and stuff like that. I just kind of made a fool of myself. So let's just keep going here. Next slide.
What
factors, growth and momentum.
What's the bet?
Oh, it's a steak dinner. That GDX, the gold miner ETF, that upside gap won't fill before the end of the summer.
Well, lucky I'm making a shitload of money on the GDX, so that means that at least it's going to pay for your dinner.
That's right. Okay, so let's go. Next slide, 9. Factors, growth and momentum leading. What do you got here?
So interesting way to slice up the market, which is through factors. So we have a dashboard which basically shows factor performance over time, and this is really important to track for several reasons. One is a lot of investments will be quasi or closet factor trades, whether it's sector ETFs or country ETFs or even other macro assets. And then the second thing is it's really, really important when factor returns start reversing because that usually shows a shift in the market, some kind of shift taking place. So just important to know and track this stuff. And right now, growth momentum leading the charge. You have when these two factors are going up, that's actually a really a positive thing for risk, bullish. When they start trading sideways and reversing, that's something to watch for on the negative side, and again, shows that something is changing.
Yeah, and so if you look there at the 3 bottom ones, value, dividend yield, and small cap, traditionally value kind of factors, and they've been getting smoked. So for all the fundamental guys that are out there trying to buy, small cap value stocks, they've been getting absolutely crushed. Now, this next chart, Rob, I must say I'm pretty excited about because I have been talking about value versus growth for a long time, and I've also been talking about the steepener, and you put the two together. Why don't you walk us through what you're thinking?
Yeah, so just two very interesting macro ideas. So one is the yield curve and what that represents, and the other one is value versus growth. And both are very correlated over the past 10 years. They're actually, if you zoom out or you look at the data before the past 10 years, which you can't hear, so let's not do that. But they're not always correlated. So I don't want to commit a chart crime telling you that they're always correlated. But over the past 10 years, they are very correlated, and for good reasons. So if you think about kind of like the yield curve as a signal for growth, that's been declining or waning, and value versus growth as the market's expectations for growth are lowered, the market puts a premium on growth stocks, and that's when value underperforms. The other thing here is more of a sector tilt. So value now is energy, it's financials, growth is tech. So when the yield curve is declining, growth expectations are lower, yields are generally going down. That's bad for energy, bad for financials. And on the flip side, that's typically good for growth as investors put a premium on secular growth and high growth industries. So really interesting. The other is, I'll point out the divergence here, though. The yield curve has been sort of flat to trying to come up, and then value versus growth has continued to decline. And that's kind of a very interesting dynamic to think about. And if the yield curve can continue to steepen, if we do have this policy shift, the yield curve steepens, that's a really interesting trade to look out for, and could mean a big reversal and a great opportunity in the short term for a tactical trade.
Yeah, so it's actually kind of counterintuitive. The fact that there's been so little growth in the economy means that investors overpay for the few growth stocks that there actually are, and leads to the growth stocks outperforming the value stocks. And it's just kind of, I think you explained it really well by your explanation. Now, I must admit, I love this trade, and I know it's also because I love the steepener trade. But I think this value versus growth, we are in kind of that period that we saw also at kind of 99, I believe it was, when Julian Robertson tapped out. He said, that's it, I can't take it anymore. I don't understand the market. And he was a famous value kind of investor, and that proved to be the bottom on the value versus growth trade. And I think we're very close. Now, I realize that to some extent I've lost the privilege of calling this bottom because I've called it so many times. But I'm hopeful that if maybe both of my trades will work, the yield curve and the value versus growth at the same time. So I think this is a great chart, and thanks for pointing that out, Rob. So let's look to this next thing: cross asset valuation, emerging market bonds.
Yeah, so looking at this is a chart I stole. I believe this is from BAML, but basically looking at cross asset valuations relative to the past 10 years. The red X is where it is in the distribution, and you look at kind of like everywhere: equities, rates, credit, everything's expensive, particularly in rates relative to the past 10 years. The one sector which kind of looks okay, or looks more on the cheaper side, is emerging market credit. And so the one kind of trade idea, I don't know if I'm allowed to pitch a trade idea, but
sure, go ahead. You go ahead.
Emerging market bonds look really good here. I think they do well in a bunch of scenarios. So if yields continue to collapse, as long as there's no systematic risk, they do well. I think if growth rebounds and there's some emerging markets outperformance, they can benefit as well. But the way to play that is kind of the next slide: EMB ETF. So I have it here, which is the easiest way to play it. And I have the ETF here versus flows. Flows are sort of up and down over the past several years. I'd say June was a pretty strong month. You saw some flows into the index. Past couple of weeks have been weak, but I think this is a chart and a ETF to watch.
Yeah, that's a great call. Now, Rob, when we're sitting here staring at all your charts, I must say that they are mighty impressive and mighty beautiful to look at. Why don't you tell us a little bit about your company, Koyfman, because these were all created on Koyfman. And I've long kind of pointed people towards this product when they want a free kind of macro, not quite a Bloomberg, but yet again doesn't have the $20,000 a year price tag. So why don't you walk us through what it is, how you got started in it, and what you can find on it?
Yeah, so I was on Wall Street for a long time as an analyst, as a strategist, as a trader. And I was always kind of using a Bloomberg and FactSet and all the other tools out there. And I was at a hedge fund in my last job in 2016. The hedge fund wasn't doing that well. I left to trade on my own, to try and put out some research, similar to what you guys do with your newsletters and your ideas. So that's what I wanted to do 4 years ago, just to keep my ideas fresh. And when I needed to kind of put the resources together and to pay for my own resources, I started to really understand the market out there for these sort of resources. And what I quickly found was that if you don't have a Bloomberg, there's no real good alternative out there. And so I started thinking about why is there no data provider or no analytics platform that gives you macro functionality, equity functionality, but doesn't cost $25,000 a year. Furthermore, Bloombergs are super powerful, but they're very difficult to use. They're not very accessible. They were designed 30 years ago, and that design never really changed. So I thought there was an opportunity to create a lighter weight, more intuitive platform for people to use. So that's why I started Koyfman. We basically three main things we provide in terms of our value proposition. Number one, super intuitive and user friendly, and that includes being free for now. You could go on our website, just start using it. So that's value prop number one. Value prop number two is we centralize a lot of interesting data. So not only equity data, fundamentals, but also economics, FX, commodities, anything that you would want to, anything that your average investor would want to look at, we bring into one place, and we can go through some examples in a second. And the third thing is not only are we providing the data, we want to provide the tools, the dashboarding tools, the graphing tools, the screening tools to actually analyze that data and to make sense of that data. So that's the three things we do. We launched, we haven't been around for that long, but we've had very strong user growth, really good feedback. And thank you again, both of you, for pitching us and pointing your followers to our product.
Well, Rob, I'll
really
tell
helpful.
you, when I was introduced to your product, Kevin actually originally brought it to my attention, and then I got in touch with you through some of my members. And I have to say that once I learned about your product, I've been using it quite a bit. It's unlike Kevin, I don't actually have a Bloomberg machine, and often I turn to your website to get some amazing analytics. So I'm a big fan, and that's why I was happy to have you on the show. So my endorsement for sure. Anyway, why don't you
sorry, I didn't mean to interrupt, Patrick. Why don't you just kind of throw us give us kind of two different or three different features that you want us to just highlight very quickly?
Yeah. So if we could, I'll just kind of speak to the layout of the system. So on the left-hand side is where you kind of could click through the menus. So right now you're on today's markets. That's highlighted in blue. So that's your main markets page in terms of what's going on. Whenever you're on these dashboards, you could actually click off. So those little boxes, color boxes, right to the right of where your mouse is. So to the right. Yeah, exactly. So you could click on those boxes, and that's going to basically impact the chart. So that's your markets dashboard where you could view different things on the chart right there. And then if you continue to click on markets, the blue, open that up. Exactly. So then you have your top news as your next thing, which is obviously what's going on in the market, world equity indices. So this is where we slice and dice different parts of the market. So these are your world equity indices. Next is your country ETFs. You can see the performance there. Next is your sector ETFs. And then the last thing in markets is that factor analysis that I mentioned to look at factors. Yeah. Equities, you macro guys probably don't care about equities, so we could skip that. Not very important. Fixed income, we have all the global yields out there, so you can actually see all the yields and again benchmark them and browse by country and see what's going on there. So really, really easy to do that.
And
okay.
Rob, I'm going to give a quick plug here, because if you go under the corporate credit, a lot of people have a hard time digging up, looking at what's going on in the triple Bs and junk bonds, and looking at credit spreads and all these different things. And you could find it all right here. It's actually really neat. That's one of my favorite things to watch for as well on this chart. So you can find it all on here. Great stuff.
So I think everybody should just go. If you're at all interested, go. It's free. There's no credit card you have to give in advance. It's not like there's some sort of trick. I guess eventually you're going to want to get paid, but that's still a little ways away, and you're not talking about that. So in the meantime, everyone should go sign up and use the resource, because it's a terrific resource. So Rob, why don't you tell us kind of where they can find you and the product, and walk us through the best places to reach you?
Yeah, so the product, just go to our website, koyfin.com, Koyfin. And again, it's a web-based product, so you can just go on the website and start using it. Just as a, FYI, you mentioned pricing. Our vision is we're always going to have a free product. So whatever you use now, it's not like we're going to lock up next week or next month. So we're always going to have a free version. And then at probably towards the end of the year, we'll have a premium version, which will include more customization, more data, more access, and stuff like that. But the free product will always be there if you don't feel like paying for it. And then we're also on Twitter, Koyfin Charts, or you could shoot me an email, rob@koyfin.com.
Great. Well, thanks for being with us.
Glad to be here.
Well, Rob, we're not going to let you get away so easily. After being on Wall Street for 5 or 6 years, 7 years, I can't remember when you told me the story, but I'm sure you have some good tales from the trading desk for us. So what do you got in store for us?
Okay, so probably one of the most memorable episodes from my career. So I started in 2002, and I was on Wall Street for about 15 years. When I was at Goldman Sachs for 7 years, that was my initial job. My next job was at Caxton Associates, which is a macro fund. I started there as an equity strategist in London.
I didn't, Rob, by the way, I didn't mean to say you were only 6 or 7 years. I guess it was 6 or 7 years at Goldman, and then you were at Caxton for another 6 or 7 for another 8 years. Is that right?
So Goldman for 6 years, Caxton for 1 year, Citigroup for 3 years, and then some buy side roles for the remaining career. So jumped around a lot. But so I left Goldman Sachs prop desk in 2008. And my first week at Caxton, I had just started out. It was October 15th, 2008. And that's when the Bank of England lowered rates by 150 bips. It was a huge surprise to the market. Caxton made more than $1 billion that day in flattener trades. And I had no idea what was going on. I was kind of like sitting at my desk, and all of a sudden, everybody's. It's like when someone wins the World Series or the championship, like people jump up and down. All of a sudden, everyone started jumping up and down, and I was like, "What is this? This place is great. I love it." And I also didn't know what a flattener was, coming from equity land. So, I was like, "What's going on?" It's like, "Oh, the flattener," and I was just like, "I have no idea what that means."
Wait, so when the Bank of England did a surprise cut, it actually caused the curve to flatten, not steepen? I wouldn't have guessed that.
I think they were. It was so. See, I still don't know anything about macro. So I think they had. They basically had. It was probably receivers. They had a bunch of receivers and swaptions on. Whatever you people do in fixed income that benefit from lower rates, it was, and they had it on in massive size, and every macro shop had it on in massive size in 2008. But that one day was just like, I think the point where basically the market just totally repriced rate expectations.
Well, that's awesome.
That's hilarious. That's a great story. $1 billion. Just like that.
Just like that.
It's like
easy come, easy go.
Like winning the Super Bowl, all of a sudden everybody's cheering their team.
Yeah. But it was so interesting though, because so many macro people were bearish in 2008, and so many didn't flip in 2009, and that was a really interesting dynamic to see. Kind of, how very sophisticated investors view the market, how they view the present. And that was actually the time when the CIO of Caxton, Andrew Law at the time, was like, "You need to learn technicals," because I turned out to be, I was super bearish because I was caught up in this whole bearishness. And March of 2009, everything started trading really well. He was one of the first ones to flip his book. And he was just like, "You need to learn technicals because the market is telling us that we're wrong." And I'm like, "Technicals? That sounds stupid." Like,
that sounds like Kevin still to this day.
No, that's not true. I would argue that when your P&L is telling you you're wrong, that's my technicals. But it's great. That's actually interesting. It's an interesting observation, and something that I've found. I'm continually amazed at how many hedge fund kind of supposedly gurus they just all they can do is go around looking for the next 2008. They made it that one period had such a large kind of outsized kind of scar on their trading mentality that all they can do is imagine it occurring over and over again.
Yeah, and chasing or trying to find the asset that's the next 2000, next mortgage crisis, and that's like one of like my pet peeves. Whenever people are just, this is just like, and then they name a year, 1999 or 2008, when in reality it's like 2008 wasn't like any period before, and 1999 wasn't like any period before. And I'm sure 2019 and 20 is not going to be like any period before. So, or it's not going to be exactly like any period before. So, that's I totally agree with that point. Whenever people try to live in 2008.
The other thing that I find, Rob, is that they all take for granted that it was so easy to pick off the .com bubble or to pick off the real estate bubble or / credit in real estate. And the reality is that if you were bearish on either one of those, you had gotten hammered so often for so long that almost nobody was bearish at the top. Like there's so few people.
That's such a great point. And I was a pretty junior analyst in 2005, 2006, 2007. But we had a really robust debate internally in Goldman Sachs research whether housing would decline or whether we didn't say housing bubble, because at the time no one said housing bubble. People said housing was expensive. I think in retrospective, because of what happened, people were saying housing bubble. But at the time, there was a really, really robust debate and really good arguments to be made of like housing is a new asset class. You have all this money flowing in. Globally, why would an asset class globally be overvalued? Something must be changing. Demographics, blah blah blah. And obviously, in retrospect, it's really easy to say like, oh, housing was in a bubble and stocks were in a bubble. But as you mentioned, like Julian in 1999 just gave up because he just couldn't predict how long it would last. So.
Right. Yeah. And it's the thing that we expect the least that's going to hurt you the most. And so I contend that that's going to be traditional fixed income when inflation comes, but Patrick's going to tell me otherwise. Anyways, thank you very much for that Tales from the Trading Desk. It's terrific. It's a great story. Thanks for sharing that with us.
All right, and everyone stick around for more Rob in the after hours. He'll be joining us once at the tail end of the show. So if you want more Rob, stick around. All right, Kev.
Okay, this week in trading history, what do you got planned for us this week, Patrick?
This is we didn't have to go too far back in history, like just a couple decades, right? Like it's been a while, but it's interesting to go back to July 12th of 1998, a little bit more than a week ago, back in 1998, when Russia secured its $11 billion financial aid package from the IMF in an effort to halt its financial crisis, but in the end didn't prevent the inevitable Russian ruble crisis that followed in the month ahead. And I figured, well, why not go back and go in history and talk a little about Russia? And so what I want to do is kind of go back and do a little bit of the timeline. And so going back to, obviously, this is now many years, numerous years after the Soviet Union collapsed, right? And so going back to April 1996, Russian officials began to negotiate to reschedule payments of foreign debt inherited from the former Soviet Union. And so they're still dealing with the fact that they had this big transition moving from the communist Soviet state to now coming in and joining the global free markets. And then they're now inherited all this debt. And so they're going into the negotiations to repay its sovereign debt. Was a major step towards restoring investor confidence in the country. And on the surface in 1997, everything seemed poised to be a major turning point towards economic stability in Russia, right? And so one of the interesting parts that almost always seems to be associated with some sort of a crisis it was the fact that they had a narrow exchange rate band band, which they kept in place to keep the Russian ruble between 5 and 6 rubles to the U.S. dollar, and so it's a peg, right? Very similar to like what you're seeing in whether Hong Kong, China, other places that peg there. But so they tried to maintain that Russian ruble in that peg. And so what are some of the other observations? Well, when their economy collapsed, they really only had their resources as their major anchor, right? So oil, one of Russia's largest exports, period, was selling at $23 a barrel at the time, which was a lot, which was the top end of the range. I mean, today, when we think $23 a barrel, that seems ridiculously cheap. But back then, oil was coming off of the teens, and coming up to 23 was a big percentage jump, and 45% of Russia's major main export of the was oil exports in '97. So as goes oil, goes its economy, right? Now, a couple of things overlap this. So it was in the summer of '97 where you had the Asian currency crisis, right, in the Pacific Rim, that came in, and so there was already a lot of nervousness going around the world, and obviously Russia, kind of as an emerging market, was sort of basketed off and with this. So because of that Asian crisis, it was back in September '97. So remember, the crisis happened in '98. So we're going back in time a little bit here. So in '97, September '97, analysts predicted that Russia's credit rating would improve, allowing the country to borrow less expensively. Limitations of the purchase of government securities by non-resident investors were removed, prompting huge foreign investment into Russia. And so by late 1997, almost 30% of all the GKOs, which is the short-term government bills in Russia, were accounted for by non-residents. So foreign investment was coming in, and the economic outlook appeared more optimistic, including the fact that for the first time in like the decade, that Russia actually showed positive economic growth. So these kind of green shoots were appearing in Russia at the time. But it was a few months later, in November of '97, obviously it was the summer when the Asian currency crisis occurred. It was in November that was the first major speculative attack on the Russian ruble.
Right.
And so what was crazy was when you try to maintain a peg of a currency, you have to defend it. And so what do you need? You need foreign exchange reserves, right?
Right.
And so what happened?
But you run out of those eventually, though.
Exactly. And so in the first speculative attack, the Central Bank of Russia burned close to $6 billion in foreign exchange reserves to defend its currency, to maintain the peg. And that was back when $6 billion actually meant something. It was a lot of money back then. Today that's just a rounding error. But back then that was a strong.
One day's QE.
Yeah, absolutely.
I'm just kidding. Actually, it's more than one day, but it's 1 month. But anyways, go on.
Anyway, so then another blow was dealt to the Russian economy in December '97, when, guess what, oil prices started to turn, right? And so a lot of that that outlook, a positive outlook for Russia, was about the fact that oil was such a huge export for them. And so just to kind of go back and show a chart right over here, this is oil prices in 96, 97, and then 98. And so you can see it was trading more or less in the mid to low 20s.
Look at how quaint is that? Like $26 and it went down to 12.
That's the whole point.
It's hilarious, isn't it funny that it wasn't that long ago that oil was trading at those kind of numbers?
Yeah, and think about it. A drop from $26 down to 11 is like a 60% wipeout. If I need, like it.
That's some good math, buddy. That's really quick on the fly. I like it.
I was guessing. Was that somewhat accurate? I hope so. Anyway, but the point is that that's a pretty big move, right?
Oh, it's a huge move. It's a collapse. It's like
and when you're emerging from the former Soviet Union, and 45% of your entire export market is energy, that this is a massive blow, and you just blew a huge amount of your foreign exchange reserves defending the currency, and then suddenly you get kiboshed by oil collapsing, right? And so this led to a series of really interesting things. So in February of 1998, so now we're going into the 1998 year, suddenly all the government risk and expectation stuff started to come in, with many uncertainties now suddenly coming into the Russian economy as investors turn their attention to now what could be Russian default risk, now that a whole bunch of foreign investors came in and invested into what they thought were green shoots in Russia, and suddenly now, like, what's going on here? But then it becomes political. In late of March of 1998, the economic situation started becoming dire, and on March 23rd, President Yeltsin, the one in that picture, abruptly fired his entire government, including the prime minister.
Yeah. So you know what? He liked the sauce even more than us.
Yes.
And he, like, there's lots of Google Yeltsin drunk. There's a lot. He's worse than the guy in the drunk car. Like, what's his name? The EU guy. I'm not sure. That guy also likes his sauce, but he likes his sauce. So I'm thinking that was done
that's
on
that's embedded in the European culture, though, dude. That's actually par for the course over there. But the point, though, like, can you imagine? It's the equivalent of Trump saying, "No, I don't like the way the Congress is going. I'm just going to fire them all, and let's just put in a brand new Congress."
You say that like it's like something that's outside the realm of possibility.
I don't like who's in the Congress. You're fired.
You're fired.
So
he's going to make a new reality TV show. Anyways, go on. Sorry, I didn't mean to interrupt your story.
No, it's funny. But like, think of the confidence when you say, "Well, I just invested in Russia, and they just completely fired their entire government." Right? And so they're going on then early May in a routine update. The chief chair central banker in the Central Bank of Russia, this Sergei Dubinin, warned the government ministers of a debt crisis within the next 3 years. Unfortunately, he forgot to mention that, didn't realize that there's a whole bunch of reporters in the audience.
That's almost as bad. Whoa, I got to tell one quick story. A side note here. That's almost as bad as when the Prime Minister of Japan, I don't know if I've got this right, when there was that terrible, what's the tidal wave, the tsunami, and then there was the nuclear disaster, and he was trying to get everyone convinced, like he was trying to reassure the public nothing was wrong. And he held a press conference, and instead of showing up in a suit, he showed up in a hazmat outfit. And I'm like, dude, like, you're trying to tell everything that's under control. Do not show up in a hazmat outfit. And I was like, I remember because I was long and I was like, oh my God. And then I was like, it immediately went offered and it was lock limit down after they saw, traders saw him show up with the hazmat outfit. Okay, anyways, back to Yeltsin firing everybody.
No, but that's funny. Anyway. All right, so it gets even better. So investors' perception of Russia's economic stability continued to decline because, the IMF and was coming in to try to work out something, some form of aid, right? But part of the international committees that were coming into Russia to kind of talk about everything was our good buddy Larry Summers.
Oh, good old Larry.
And so he, at the time, was one of America's top international finance officials. But he went and he was denied a meeting with the Russian prime minister while in Russia because an inexperienced aide determined that Summers' title of Deputy Secretary of the Treasury was unworthy of the prime minister's audience. And so the two never met. So here you have a chance to fucking show some stability with Larry Summers, who at the time was like the deputy secretary, coming in there to kind of show some stability. The Russian PM wouldn't meet with him.
My goodness.
Because he's unworthy of his status. And so at the same time, the IMF left Russia unable to reach an agreement with policymakers on an austerity plan. And then just keeps going from there. So liquidity, monetary policy, and fiscal policy just kept escalating as in May 18th, the government bonds swelled to a 47% yield with inflation running at 10%.
Don't worry, everything's okay.
Everything's okay.
Everything's okay. 47%.
Oh, dude, it gets better.
I'm good.
It gets better than this. All right. So then the Central Bank of Russia responds by increasing the lending rate to the banks from 30% to 50%, and in 2 days used $1 billion of Russia's low reserves to defend the ruble. So then they're using up the last of their reserves to defend this peg. Meanwhile, like we were showing on that chart, oil prices just keep dropping, right?
Right.
And they dropped to $11 a barrel, which is less than half of their price level earlier in the year. So the oil and gas oligarchs were advocating devaluation of the ruble, which would increase the ruble value of their exports. And in light of this, the Central Bank of Russia increased the lending rate again. But get this. The Central Bank of Russia increased their lending rate to 150%.
Yeah, but it's just overnight. Like it's like
still it's 150%. Yeah. So
it's not good. Like it's tough for your economy to function when you got 150%.
Right? And so the Central Bank of Russia chairman there, that Dubinin, responded by stating, I love this. When you hear talk, I'm not going to try this accent. When you hear talk of devaluation, spit in the eye of whoever is talking about it.
That's always a good plan. Like that's how to fix the problems by
just spit in their eyes. So
just spit in their eye.
Screw these oligarchs who want devaluation. So then it comes July 12th of 1998, which is this date in history where the IMF comes in, provides additional assistance of $11 billion, which $4.8 billion was distributed immediately, replenishing the coffers of Russia. Yet between May and August, approximately $4 billion had left Russian capital flight. With all of the revenue sagging because of oil prices and the liquidity, the IMF assistance did not provide much relief at all. It was just barely enough to just keep them afloat. And then a month later, on August 13th of 1998, the Russian stock and bond and currency markets collapsed, right? And that was
shit the bed. Shit the bed. There's no other way to describe it.
So here's my favorite way to look at a currency thing, because most people look at it the U.S. dollar or ruble, but I insist on always putting the main currency against the dollar. But you can see the collapse from 16 cents to about 4 cents, about a 75% wipeout of its currency in literally days.
Yeah,
right?
Just brutal.
It was 75% just like that, boom, overnight, just like, so when you hear like Kyle Bass talking about like eventually what China would have to do with a deval, like this is, that's chump change compared in percentages anyway, not in aggregate size, but in terms
that's
of
still too bullish compared to what Kyle Bass thinks that China's going to have to do.
Anyway, but it was a complete collapse. And so it led to the government to have to default on its domestic debt in its entirety, or both. So there's your domestic debt default that so many people talk about when dealing with the global debt we see today, as to whether that's even on the table. But the annual yields in the ruble-denominated bonds were more than 200%.
Yeah. Well,
the stock
listen,
market had closed.
It didn't function anymore.
No.
It's just like you can't look at that point.
It was pennies on the dollar, right?
Yeah,
and the stock market had been closed for 35 minutes, like because they had to close it because they went limit down, I guess, for their thing. They had to shut it down. It was down 65% when it opened the next day.
Well, do you know who was one of the biggest investors in Russian bonds and kind of was the
who?
Long-term capital management?
Really?
Yeah.
Great investment.
Long-term. Yeah, they were. That was one of the original positions that kind of started the whole 1998 long-term capital crisis. Kind of crisis was caused by this initial default on the Russian ruble. So they lost $430 million on Russia.
Wow.
It wasn't actually that much when you go look at the other how much they lost and other stuff. They lost,
but it contributed to the whole thing. Right?
It was the start of it, and I remember that summer very well because I was a young whippersnapper trading on an institutional desk, and the liquidity disappeared. And I remember being trading and stuff just going no bid, and I remember guys chasing gamma, and I was short gamma too, and there's like points where there was just nobody to sell to. There was just nothing. There was no bids. It was a summer situation. There was no liquidity. And I remember at one point we just turned off our computers and said, listen, either the world, no, honestly, you think that's a joke, but it was like, we were like short all this gamma, and it was like, okay, either the world's going to end and then it's going to not matter, or it's going to bounce. But like, it's just cause it just went no bid. It was dumb to sell because there was nobody to sell to. There was just no bids at all. Right. Guys would come ask me for a bid. I would buy baskets like below the bid, like a percent under the bid. I would go to put them up and I would sell them. I would sell like 25% of my position or something. Then I'd be long 3/4 of it still. And not only that, all of a sudden the market would move more. So therefore I would be getting longer because of my gamma. And then the same guy who just pitched me all these baskets would phone me up kind of 20 minutes later and say, I got to sell more. And it just ended up being just stupidity. It was just, in hindsight, it was just compared to 2008, it wasn't that big a deal, but it was pretty crazy at the time. So I do remember that.
What I think a lot of people don't appreciate. I mean, our listeners are a smart bunch, and many of them have been through a lot of these things. But most people don't appreciate how liquidity can disappear. It's a coward. It's a coward. When you need it, it's never there.
It's gone. For sure.
And there's a lot of people that always warn about this in the junk bond markets and stuff like that. Like when shit hits the fan, that there isn't going to be the liquidity that a lot of people are going to be looking for in this kind of stuff. Anyway, but let's just go back to the story because I just want to wrap this up. So in the end, the stock market wiped out 75% in Russia, 39% alone in 1 month. Right, and Russian officials were left with little to no choice, so they floated their exchange rate. It wipes out to the downside. They defaulted on all their domestic debt, halted payment on all ruble-denominated debt internationally, and declared a 90-day, moratorium on payments by commercial banks to foreign creditors, and they basically seized it up, and that was the Russian ruble crisis.
And you know what's interesting? I'll just leave you with one thought. It was actually interesting because they did default on Russian ruble denominated debt, which a lot of the kind of more MMT-like guys like me will tell you that you can never do, because the reality is that you can always print more, and they actually did default on their own currency.
Right. And that's, there you go. That's food for
Great
thought.
story, Patrick. Thanks for sharing that with us.
All right. So, Kev, it's time for your segment here. The WTF Clip of the Week, buddy. What do you have in store for us?
Well, I saw that the fellow from J.P. Morgan, Bob Mitchell. I think they pronounce it Mitchell. I don't think it's pronounced. It's spelt like Michelle, but it's like I think he pronounces it Mitchell. He had a bold forecast, something that must be near and dear to your heart.
All right, let's see what do you got?
Let's see. Okay.
How much lower can we go? How far is the gravitational pull on that 10-year yield?
Yeah, shouldn't we, learn by dodging balls that are thrown at us, or?
That's what this sack of wrenches is for. If you can dodge a wrench, you can dodge a ball.
What?
All the way down to 0.
Wow.
And I think that's where we're headed over the next couple of years.
Are you okay?
I'm fine. I just threw up in my mouth a little bit.
We've had the recovery, it's coming to an end, and now the central banks, one after another, are falling into line and cutting rates.
Yeah, in some cultures, they only eat vomit. I've never been there, but I read about it in a book.
Saw it overnight with the Bank of Korea. We've seen it with the Bank of Indonesia. You're going to see it at the end of the month with the Fed. You may see it from the ECB sooner than people expect. And we think at this point in the cycle, you need some shock and awe.
Oh, now there's a souvenir for a lucky fan.
So I'm not saying we're going to get there right away, but that's the journey we're on until something different happens.
You can dodge traffic, you can dodge a ball.
Bob Michael, what you just said is absolutely stunning. Let's revisit it right now. Bob Michael has a vector on the 10-year to 0%. Did I hear that correctly?
I'm fine! I'm okay! Okay, I'm fine!
You did, and I'm not saying it's going to happen this year, but I think we're getting to a point where things are rolling over. There aren't trade tensions. We're in a trade war. You're seeing the impact on corporate earnings. You're seeing the central banks now forced to scramble to react to that. And by the way, they haven't been able to create higher inflation expectations over the last couple of years. So the only thing they have left to do is to cut rates as far as they can and probably expand balance sheets.
Yes, no, I'm being told that Average Joe's does not have enough players and will be forfeiting the championship match.
It's a bold strategy, Cotton. Let's see if it pays off for him.
Oh my god.
Lena, Lena, come in here, Lena.
I'm crying.
You're crying.
So funny.
That was awesome.
Dodge a wrench, you could dodge a ball.
I like the traffic scene personally better. The wrench actually has more impact.
The wrench. I actually like Tom Keene saying, "Did I hear that correctly? That you're calling for 0% rates? 0% 10-year, not 0% front. A lot of people are saying that the front end could go to 0. Tom Keene's like, "Did I hear you right? That you think the 10-year is going to 0?"
You know what? He's a smart man.
Oh,
he is
God.
one smart man. You know what? Listen, we're gonna save this for the stage.
Yeah, no, we're not gonna do it. But he kind of, don't you think, Lena? He looked like the guy that was dodging traffic. He looked a little bit like.
I was gonna say, he looks very familiar, but I can't put my finger on it. But you're right.
They kind of look the same. Like he was dodging traffic.
Oh, he definitely was.
Anyways, listen, Dodgeball, classic movie, awesome, underrated, one of the best comedies out there. So stupid, but so great. And the part where she says, "Oh, I just threw up in my mouth," that's what I just, when I heard the 0% call on the 10-year, that's what I felt like. So I was like, I had to go with that.
You know what? The next 2 years are going to be very difficult for you, Kev.
For sure.
When dealing with the future realities is going to be something you're going to have a lot of emotional conflict, and it's gonna you're gonna be wrestling with a lot of these demons inside of you that are gonna.
I'm gonna have a lot of mouth throw up. I completely understand that. Some societies they eat that or whatever.
Or spit it out?
Yeah, I don't know.
But you read that in the book, didn't you?
Yes, I did. Something you don't know anything about, Patrick, because you can't read.
I only go on the audiobook.
That's right. Let's move on to the top 5 things to watch next week.
All right. So, Kev, though, when we go to the top 5 things to watch next week, we got to start with last week, right? And so,
okay, yeah.
Let's take a dive for a quick review. So, bond yields, right? We were talking about it, and surprisingly, they're not rising.
Surprisingly, they're not rising. Listen, they actually did rise for a while. There's a lot of volatility, and I see actually the fact that.
Oh my God! Stop for a second, okay? You're telling me, like, we are literally at 2%.
No. Yeah, but think about last week. We were pushing 194. We had a big move.
Yeah,
to
20. It was a 25 basis point swing. I guess that's not chump change. It's not.
You know what? Like, I might be doing a little bit talking like the fact that it's going my way. It feels better than it is. I do see that what I find interesting is the fact that the odds of a 50 basis point cut at this July 31st meeting were 20% a week ago.
Right.
35% this morning. We're taping this on Thursday, by the way.
Yeah.
35% this morning, and they're now 69%. We're back to the Fed cutting 50 basis points. This market is
that? You know what it is? Because number two, the retail sales must have come in so bad, and the economy is sucking so much wind.
No, I don't think it is that. Because the reality is, let's go look at the retail sales this morning.
No, we'll get there in a second. Point is that it's crazy though. That the data after data comes in strong, and the Fed is like, nah, we got to do 50.
Well, I don't think the Fed's saying that. I think the market
is
trying to. The market is trying to bully the Fed into doing 50.
Hustling.
Yeah,
it's going to bully
them.
Good
for them. Listen, if they get it, they get it. Go for it.
Yeah, Goldman Sachs beat.
Yeah.
Well,
and
the stock didn't really move on it. Let's be realistic. I mean, it's still at 215 the way it was when it was going into the earnings, right? So
I saw one of our listeners commenting the fact that when we were having a discussion with Goldman Sachs, that I was buying I was buying the technical breakout, and you were selling it on fundamentals. It was like bizarro world for everybody.
I just wanted before making a technical call, I wanted to see what the earnings came in at because
you're
my
a true
God,
technician. So now that it's up, you're gonna like say it should keep going up. You have to admit it's holding in there pretty good.
You know what though? Did you see what happened to Morgan Stanley? It didn't really break that bad. I mean, it disappointed, but there's yeah, the banks have actually held in a little bit. I mean, I know Wells
I think there's
Fargo's
better places to short than the U.S. financials. I think the U.S. financials might be one of the better performing sectors of.
I mean, a lot of people view them as a value play here, don't they?
Yeah.
I have a hard
I'm really
time
bearish.
thinking.
Like, as you know, like I've become somewhat like bearish about the U.S. economy and especially the U.S. stock market. Actually, I shouldn't say the economy. I am kind of thinking that the U.S. economy will be fine, but I think the U.S. stock market is going to have trouble. And I still like the U.S. financials. I think that they're behaving well, and they won't be what get you into trouble on this next move down.
Oh my God, I'll take the other side of that. Like, look, you know what? They are, as far as I'm concerned, beta 1. If you're going to have a 20% wipeout in the stock market.
Yeah, but I don't think we're going to have a 20% wipeout. That's the difference between you and I. You
it
has to be like all or nothing.
Look,
so you think it has to be this crazy decline.
Look, I'm not using that as my base case forecast. All I'm saying is that the likelihood that if they're beta 1, which is I was saying, okay, well, let's use 10% so that it's less intimidating for you. The point is, I think that if the S&P wiped out 10%, the financials will be down 10%. I seriously doubt that they're going to buck the trend, right?
Okay, so here you go. Here's something for you to kind of chew on to gain the.
I love chewing on things. By the way,
what about if we had a situation where the S&P doesn't go anywhere, it drifts lower, it goes to 2,900, maybe 2,800 over the next, I don't know, quarter, and in the meantime, financials grind higher, and also at the same time, the rest of the world stock markets rally. Would that just blow your mind?
Yeah,
because
that
like
would.
The reality is,
I'd feel completely out of my skin. Yeah.
Yeah. Well, I think that's what's going to happen. That's my feeling.
China numbers still like blah.
Yeah. Well, they're all made up anyways. I don't like we put them on the top 5. I don't know why we do, because it's true, and I'm the first one to say it. The China numbers are made up. I have a good buddy that he actually worked in China for a long time, and he had his best friend in China. I met him, and he told me the fact is that there's some rule that if it's above, like, I don't know, 40 degrees Celsius, which is really bloody hot, they're not allowed to operate anything in Shanghai or wherever it was. And the number of days that the top the top of the high of the day ended up being 39.9% was abnormally large. So the reality is that the numbers are all made up. I'm never ever going to say that those numbers are real, and the fact that we look at them is probably, just shows you how naive we are.
All right, so retail sales came in hot.
You have nothing to say.
Okay, no. Listen, all the data was hot, and what I find amazing is that this paradox we live in, which is that good news is bad news and bad news is good news, and the strongest economic data keeps coming in, the more nervous it makes the bulls.
Yeah, but you say the retail sales were hot. Like, yeah, they were hot, but the reason these numbers are coming in quote unquote hot is because you bears have made it so you think the world is ending tomorrow, and when it doesn't end tomorrow, you're basically like, oh my God, look at the.
Oh my God, so you're bearish, and then you say you bears.
No,
you joined the dark side right now.
No, because
so you're not a bear. You're not bearish.
I am a dark side convert, recent dark side convert.
No, you're just a contrarian, which is that if everyone thinks that retail sales should be weak, you're going to think it's strong. That's your problem.
But the reality is that you guys often think that the economy has to equal the market, and it doesn't.
Identity politics here. You guys.
Okay. We're too many beers into this. I think the fact that it's the heavy 6.3 is making this a pretty shitty top 5 things review. Let's just go. Let's get it over with. Let's pull the Band-Aid off and go on to number 1.
Earnings. And so far, the financials have been coming in line. They haven't moved that much. The big,
except for
obviously,
Netflix.
Yeah. All the golf ball and the garden hose of earnings is still ahead of us, right? Like we're not a big wave of financials came out, but yeah, you're right. Netflix was the first kind of big disappoint. I always call earnings season like earnings hand grenade season, which is one stock has its pin pulled and it fucking blows up, boom. And Netflix was the first one to have its pin pulled, and that doesn't look pretty, does it?
No, it doesn't. I've been waiting for the signal on this thing. I might
take on some shorts?
Give it a couple of days for it to kind of rally back up to 340. No, it's not going to gap fill. It might rally back up to 340-ish, and I'm wondering if that's the point where you give it to them. Yeah.
Look, you know what? That's not a pretty break. Like, you know what? We'll see what it does throughout the next week, but that's not pretty, buddy. That's you don't have to be a CMT to know that's not a pretty looking chart.
Okay.
All right. So it's time to move on. So Kev.
Okay.
Top 5 things to watch next week. So for the top 5 things, number 6.
What?
No such thing as a bad tick. So okay, look,
Wait,
we added a number 6 because I really wanted to talk about your bad tick, and we couldn't figure out which one of the top 5 to
That's right. We had such a good top 5 that we decided to make it the top 6. So bear with us. Let's go.
Okay. It was just simply
no such thing as a bad tip.
I just wanted to talk to pound sterling. Because you know what, we've been looking at the Aussie dollar and the Japanese yen for the no such thing as a bad tick gap fill type of thing that we wanted to. But there was this little tick down over here on the pound sterling going back from December, January of 2018-19. And guess what it did?
It filled it. See, I told you.
No
there's
such thing
no
as a bad
such thing as a bad tick.
So
you laugh. And
no,
but
laugh
at my
this
squiggle
worked.
analysis. There we go, baby.
This worked for you right now. And you know what? Listen, I'm totally open to you being right on this. This to me, this is new for me. So I'm looking at this more as a case study than rather to trying to fade you on the other side. But like when you look here, this is the yen US dollar. Let me do it the opposite way because you're gonna freak out on me.
I'm getting used to your.
So here's your no such thing as a bad tick US dollar yen bottom, which is at 105. Yeah. And you know what? It might still happen, right?
Yeah. Don't write it off, baby.
Anyway, the pound sterling did it. The pound sterling did it. It did it.
Because I have something to tell you about the pound sterling.
Tell me.
I am looking to get long. I'm picking my spot. I want to sell euro pound so bad, and I'm just been watching. I remember kind of thinking about it. Can you pull up Euro Pound for me?
Yeah.
So this is like the BMW Jaguar spread. So the BMW Jaguar spread was behaving really well in May.
Until you started talking about it.
Yes, and I talked about it, but
you called the bottom.
Yeah, but I'll tell you why I didn't do it.
Tell me why you didn't do it.
Because every hedge fund in the world was short this thing.
Really?
Yeah, it was one of the most popular trades around, and they just got their face ripped off.
Yeah,
that's straight up since then, and I just think there's a world of pain. I still think it's going to work. I'm waiting for my moment, and I want to sell this, and I don't know where it is. Part of me thinks I should just suck it up and put some on.
Hey, the bad tick was filled, so now.
Yeah, maybe that's it. Maybe I should have just used that as my signal.
You should.
The fact that I'm not doing it means that our listeners should put it on in size. Okay, number 5.
Number 5. What's going on with commodities? Now, there's a lot of stuff we want to cover, but let's make it super efficient because we can't just spend like an hour talking about it. Let's start with crude. Right?
Okay, it sucks.
Yeah, but
it's and I'm a big crude bull, and it's there's no doubt about it. It's trading like death. It's terrible. Today, for example, is down another $2, even with.
But it broke the June low, right? And so that as a technician, like the fact that it tried to rally, it prairie dogged, right? So first of all, the first thing you've got going against you is the fact that it prairie dogged above that $60 mark, stopped everyone out that had their stops a little too tight, and then just broke to a little bit of a lower low from its last thing. That's all very bearish price action. Now, we'll see how low it goes. I mean, anything that drops this much in 5 days, that drops this much in 5 days is going to bounce. Like,
what about the chances it just porpoises for the rest of the summer between 50 and 60? Like up and down, up and down. Well, and then all you technicians will be selling the lows, buying the highs.
Dude, look, if it goes down to 50, I think that's a victory for the bears. Like, I mean, then if it bounces back to 60, it bounces to 60.
Okay.
But
as long as you get bullish down at 50, I'm fine.
Right. Okay. So now the second thing I want to talk about is gold.
Yep.
And like WTF right here, like that's, I mean, I was recording earlier with Eric. It was still down at like 1430, and like
who's Eric?
Yeah.
You're cheating on me with somebody else? You record another podcast, Patrick?
Yeah. Enough said. I will not mention the competition. All right. So, but the point is that we're at 1450, and that just happened in a couple hours, in the last couple hours, right? And it's not showing clean on that chart, so I'll switch it to 4-hour chart. But like this is a technical breakout.
Oh my God! Really?
This is
like you're gonna. So
I mean, okay, look, you know what? You'll be doing your prairie dog victory lap tomorrow. But the fact is that when you have a breakout like this, the continuation patterns to 15, 15, 50. Like as a technician, that's where it measures to. You know what? Right now, gold has broken out. Let's see where it goes. Looks bullish to me.
You know what? I can't disagree with you. You're right. I shouldn't give you a hard time about that. Actually, you're absolutely right. It is. It's trading like it wants to go higher, and the fact is that.
You're about to get a steak dinner out of this, dude. So you shouldn't be.
So listen,
about this
one of the things that I will talk about is that I have for a long time argued that the central banks around the world are buying gold, and you see Poland recently doubled the size of the reserves. And we can talk about all the squiggles you want, but the reality is if they come for the gold, it's not going to matter. It's headed higher. So I'm with you. I'm a bull.
Two more commodities. More commodities. It's amazing that lumber gave back that gain. I mean, we once again foobarred the we totally like Hulk smashed the entire lumber rally. Like the moment we brought it up and said, "Oh, it's rallied 25% in 5 days," and like we got all our
no, because we didn't tell anyone to buy it. We told them to watch it. Anyway, like a fool, tried to buy the dip into the 200-day moving average, and I'm wearing it since then because it sliced through the 200-day like a knife through butter, and like it's ugly, and it's trading like shit. It's not. Listen, it's an ugly contract. Like usually it's limit up or limit down every week. Like it's kind of crazy. I still like it. It's one of my long-term kind of positions that I want to hold for the long term because I'm at the end of the day I'm a housing bull.
Yeah,
I'm a housing bull.
And so lumber's got to work eventually. Anyway, the last commodity. I'm going to do a shout out to one of my Big Picture Trading members, Nazir, who was looking and looked at the orange juice chart. And
Duke.
Exactly. Looking at OJ futures. Now, this is neither bullish, and the predominant trend is bearish. There is no doubt about this. But whenever a short-term low comes in and then it consolidates, it's a very interesting level to watch. And so OJ's been trading at like $1 a pound. It's a nice little friendly contract, right? 15,000 pounds.
Yeah,
is the multiplier.
It's like a little mini guy.
It's
like
a mini guy, so like 15 grand for a futures contract on that.
Patrick, a big shooter like you could trade 1,000.
Yeah, no, I could too. I could roll big with the OJ futures, and so Jesus Christ. Anyway. But I'm curious which way it will break from here. Look, you know what? It may just be early. Like what we've seen in OJ is that every time it's tried to rally, it's made a lower high and then broke back down to lower lows. That has not yet officially been broken as a technical trend of the primary trend. And so like nat gas rolling over, this thing could still go for another leg, but at least we can talk about it and say, is OJ going to bottom here? And maybe
me, I'm always bullish on the commodities, especially down here when this bombed out as OJ. I'm a buyer.
Well,
plus,
you know what?
I hear the report is going to be really good.
Really? What do you know the date? You're just making shit up.
I heard from Beeks that everything's going to be okay.
All right, number 4.
No, wait, you didn't. Well, you promised me you talk silver, and you never talk silver.
Okay, fine. Dude, you know what? Listen, I went long silver, but I won't lie. You went long silver first, and you were bullish pretty hardcore at the bottom. You said I'm more bullish silver than I am gold. You fucking nailed it. I'm going to give you kudos. I'm going to give you kudos.
To be fair, I was kind of early on the gold silver spread, and I don't know if I got the exact top. But I still think silver is cheap. I think it's headed higher, although I am a little worried, Patrick, because everyone seems to be agreeing with me today.
So now you're going to be a short seller of silver because too many people are agreeing?
Listen, just because everyone agrees with me doesn't mean I fade it. It just means that I might sell it because I don't like people agreeing with me. Anyways, number 4. Let's have a look.
Number 4. Listen, we're going into the big golf ball and the garden hose phase of the earnings season. And so, in the next 10 days, like, what is it, like 30 or 40% of all earnings are going to be released, some crazy amount, or even 50%. It's like a huge amount of earnings in 10 days. And so 2 of the bigger ones are Amazon and Boeing. The reason I chose Boeing is because obviously it's had all of the problems with the Dreamliner, right? And or the Max, sorry.
The 737 Max.
Yes, the Max. And so I'm curious whether bad news becomes good news, like whether it's all been baked in. Odds are that they're going to be feeling the after effects from it. But the question really is, has it been baked into the cake, right? And so a lot of that is about how it reacts after its earnings. And so here, we're very similar to the way that orange juice is sort of consolidating. You have this kind of like sideways triangle. It's basically neither up nor down, just chopping around right in the middle. And odds are, I feel that earnings will be a big tell. And I personally still think it's going lower. But if it comes out with negative earnings and the stock doesn't go down on it, that's a tell, isn't it?
Yeah, I guess so. I thought you picked Amazon and Boeing because they're both Seattle companies.
Well, that too.
I thought that's why you picked it. Why Amazon then? So walk us
well,
through
Amazon's just a behemoth, dude. I mean, it's $1 trillion capper, isn't it? Like, and so
I don't know. Let's look here.
It's pretty
Is it
much
$1 trillion. No, it's a 973.
Oh, sorry.
It's not a
rounding error. I'm not allowed to round up.
Okay, I'll give it to you.
All right, so
but it's unbelievable. Like, it's crazy how that thing continues to just go and go and go.
Right, and it kind of reversed with the whole market here. But I mean, listen, if it has a bullish gap on its earnings, it's going to clear $1 trillion and go. Right, like so. I'm not saying it will. But I'm so curious. I mean, listen, the whole point of this episode is to say things to watch. And watching whether Amazon gaps higher on its earnings is one of the more interesting things, wouldn't you think?
Yeah, I think Mackenzie Bezos is going to have some offers up above. She's going to be like sold to you. Anyways, number 3, let's go.
Energy.
Oh,
well, okay,
God.
Look, we talked about oil just a second ago. But
but you also want to talk nat gas because you were shitting all over my favorite little commodity. And
dude, I'm not shitting over it. I actually
you were saying that the stocks weren't doing well, and I was looking at it.
They are not. Well, they are not doing well. Now, listen, that doesn't mean I don't own some, but they're not doing well, dude. So the point here, like nat gas, broke back down. Now, I have a theory. That this is going to be a bottoming formation. By the way, some of my Big Picture Trading members have come up with the reverse prairie dog name. It's a duck dive.
Oh, yeah, what? It's a duck dive. Oh, I like it. It's like a surfing term.
Yeah, it's like a duck dive. So what happens is that, like, if this is the low, and if we have that, like, break to a lower low to wipe out the stops and comes back up, that's a little duck dive.
Oh, I like it.
You like it?
But see,
like,
you're already assuming it's going to go. Maybe the duck dive was already in June.
But what do you think of the name? Is the duck a noble animal?
Duck is a very yes, it is. It's a Canadiana. Like, it's great. Duck dive for sure. It's like a mallard dive.
Yeah, mallard dive. Then maybe mallard dive. That's better than a duck dive.
Sure.
Is it? All right.
I don't know.
Anyway, point is,
we should pick one that's even more Canadian.
I like your idea that nat gas is going to bottom. But listen, the energy stocks are value. There's no doubt about this, and they have been slaughtered. And like, okay, I'll start with a Canadian favorite with Encana, just broke to a fresh new low. But to take Chesapeake, breaking to a fresh new low. Our Cuppy favorite, Sandridge, breaking, well, actually not a fresh new low, but breaking right back down to towards the $6 lows. You take something like
huge outperformance there on the Sandridge.
Oh yeah, absolutely. But look at like Gulfport Energy breaking down to 3.66. I remember like a year ago writing puts on this thing around $10 and making money. The thing's at $3.66. Like,
You're right, Patrick. You're right.
These things,
they suck.
They are trading like shit. But you know what? There's a lower bound of zero. Unlike it's not an effective lower bound like the Fed. These things can't really go negative. There's a lower bound of zero, and we're approaching the lower bound of zero.
So listen, I have you know what, that reminds me. I have a story to tell on a Tales from the Trading Desk one time of a stock that actually traded at negative. And we'll
bullshit.
Save it for yes. I'll tell you the whole story on a Tales from the Trading
next
Desk.
week.
Remind me.
Next week it is. Next week it is.
Okay, next week it is. Number 2. What do we got?
Number 2. Well, that's yours.
Oh yeah, ECB press conference and European PMIs. Okay, so this is what I have to say about Europe. Yes, I know everything sucks in Europe. Yes, I know that there's no way they can fix it. Okay. But so does the entire market. And the reality is that the expectations are so bloody low that it won't take much for this to outperform.
Okay.
That's what I feel about this. And it's just, everyone tells me, you know, I was chatting with a fellow on Bloomberg today from Italy, and he kind of understood my argument and he acknowledged it that Lagarde might signal a change in the fiscal spending of Europe. But he's just like, I think there's going to be a crisis first. I don't think anything happens until there's a crisis. And I understand that argument, and I buy it, and I completely like.
But their stock markets have been holding up pretty good, though.
No, I think their stock market's been trading well, and I actually think that Lagarde, it was a change in attitude amongst the European elite.
Okay.
And no longer was there an academic in there that was just going to do more and more monetary stimulus. I think she was put in there to do more fiscal. And I think, and so this is my.
That's going to be a new trend in the world in general.
For sure. And I think the Lagarde was that. And now people will say, oh, but she's not even in there yet. And oh, it's going to still take a while for it to happen. And I don't deny those things. But I think that the expectations in terms of what's in the market, right now there is zero expectations of them ever being able to do any fiscal. There is zero expectation for their economy to ever bounce. So if you are, a large money manager that says, hey, wait, I'm not sure if they're going to be able to do fiscal, but I think at least there's a chance. Like a chance. Like, Dumb and Dumber when, say you're saying there's
1%.
a chance.
So there's a chance.
There's a chance. So if there's a chance, it has to get repriced higher. So even if I'm wrong and they can't do fiscal, and even if they can't, change anything, and it is a shit show that's just going to continue doing bad, the fact is that if the attitude about their ability to have a chance to do it changes over the next couple of months.
Kevin Muir, the ultimate contrarian.
Well,
you know what? I love it. I love it.
Okay.
No. You know what? You might be right. I'm not. You know what? I'm not going to make you a bet on this one. It's hard to become any more bearish on Europe than it is now.
And I tell you, I actually went and I bought. I am short Boons, and I am long European stocks against short U.S.
How about
and that
long?
And that is how contrarian I am because
can you tell me that you're long Greece? Tell me that Cuppy.
Oh, I am long Greece because
there you go. That's all I need to hear. No, don't say anything else.
Cuppy says something, I got to go for it. Cuppy, man, that guy's like gold.
All right, well, okay,
look at this thing. Greece, the Grek, GREK, US.
No, it's a buy on dip here. This thing's going to 12.
Cuppy, he's awesome.
Rock and roll, Cuppy all the way.
Yeah, Cuppy, we got to get him back on. We got to wait for his next call, and then we should get him back on.
Yeah, for sure.
Because the guy's awesome. He's awesome. Cuppy's awesome. No, really, honestly.
Yeah, I love him.
If you could go drinking with one of our guests, because Cuppy, you his picks are awesome. If anything, Cuppy's worse than me. The moment his stock goes up 20%, he gets rid of it. No, seriously, that guy is such a value investor. He's like, holy shit, there's some people who actually like this stock. I better sell it. He's worse than me. I am a contrarian. Cuppy's worse. That's all I can say. I love him to death, but he's worse than me at hanging on to the winners. Okay, number one.
Number one, U.S. GDP, right? And obviously, the last time this came in was at 3.1%, 3.2. You can see here the little chart. Will we see the trend of good economic data from the U.S. continue?
Okay. So, first of all, I think the GDP is a backward-looking indicator, and I think it's useless. Okay.
Well, so is a lot of the data we just saw in the retail sales were backward-looking.
Yeah, I get it, but some are worse than others. I think GDP.
Yeah, so this is now a whole quarter versus a whole past month, right? So this is worse.
Yeah. So I think GDP disappoints. I actually think that the U.S. that Trump did a lot of damage with the trade war, and that a lot of plans in terms of spending by corporations was put on hold, and it wouldn't surprise me at all if we get the GDP number that is as bad as you kind of economic bears believe.
You think so?
Yeah, I'm not bullish on that number. I don't think that's because I would rather I kind of think that. That yes, he did do damage. I'll be the first to acknowledge that his uncertainty has put corporate capex on on hold, and that it will affect the economy, and you will see it in the numbers. I'm just not sure about it going forward, and but anyway.
Well, ladies and gentlemen, that is your top 5, 6 important things to watch.
Top 5 things, starting with number 6. Good job, Patrick.
All right. So parting words of wisdom.
Okay.
What do you got, Kev?
So this is a good one. So it's by Benjamin Disraeli. And I'm just going to read it, and then I'm going to talk about it. So what we have learned from history is that we have not learned from history. I definitely agree with that. But when I saw who said it, I had to kind of put it up there. Do you know who Benjamin Disraeli was, Patrick?
Is that a trick question?
No, it's not. Like, do you actually know who he was?
No.
Okay, yeah. Most people don't. He was actually a British prime minister from the 1850s.
Okay.
And actually, interestingly enough, he was the only Jewish British prime minister they've ever had. But you know what? I got to tell a story about Benjamin Disraeli. I know about him because we, I know you're not a huge dog guy, but my family are big dog people. And so I grew up with, some big dogs in my life. And our first dog was named Disraeli. Now, he unfortunately had hip problems and had to get put down. But the thing was that everyone gave. It's not funny. Buddy, he didn't get put down. He's a big Rottweiler. We had Rottweilers growing up, and I know that sounds terrible, but our Rottweilers were actually very, very nice and very nicely. But this one had a hip problem, so they had to put him down. So my mom named him, and my mom was a history buff, and that's why she named him Disraeli. And it was always, people were like, Disraeli, what the hell is that? And people didn't know who Disraeli was. And so when the second dog came along, she said, I'm not going to name him something like fancy like that. I'm going to name him something really, really mundane and pedestrian. So you know what our next dog's name was?
Benjamin?
No. Thumper. After the rabbit in Bambi. She's like, so we went from Disraeli to Thumper.
All right. So what is the part that your mother didn't learn from history from that?
I don't know. But Thumper was a great dog, and he was
what you've just proved to our listeners is that you've had one too many beers.
Yeah, fair enough. Anyways, that's my story about Benjamin Disraeli. Look him up. Very interesting fellow. He was actually the founder of the modern Conservative Party in Britain.
Nice.
Yeah. So you know what? And there is. He was a wise fellow that obviously had some great parting wisdom. So look him up.
But you know what though? In fairness to that statement, it's so true. What happens is that people's memories are so short term. And they only are learning from their most recent experiences. This is what, that was really interesting, that piece Ray Dalio put out in terms of the paradigms and the fact that we're going into a paradigm shift. And what's interesting is like, in a paradigm like this, it's like, well, let's say in Canada we had the real estate bubble, and a lot of Canadians had legitimately the view that real estate only ever goes up. Why? Because in their experience, every time they bought real estate, it only went up. And what happens is that they're not looking through history. They're only looking at their most recent experiences that they can recall. And we rarely, as humans, ever go back and really learn from history.
So that sounds like somebody I know's Bon bull call, but we'll just leave it at that.
Oh, my God. You just...
I have to put in my dig. So listen, thanks for everyone for listening and putting up with both Patrick and I for this long. Don't forget that this July 21st, Sunday, we're going to be in Chicago. Patrick's driving tomorrow. Patrick and Luke are going to do the old Blues Brothers.
It's going to be awesome, dude.
They're going to put the sunglasses on at night and drive to Chicago.
What did you see the scorching heat that's supposed to what WTF? Like, what is going? Like, it's supposed to be like 35 to 37.
A lot of our listeners are Americans, so you got to put that in their language.
It's supposed to be what, like 110 degrees or something?
Yeah,
it's like stupid.
It's gonna be stinking hot, but it's gonna be fun. Heat. It just makes you know what, you got to hydrate. Stay hydrated.
Well, absolutely. In Chicago, long as the beer is cold and the air conditioning works at the establishments, then there's no problems, is there?
Right. So July 21st, Sunday, 2 p.m.
Watch Kevin
public house.
Be shamed, publicly shamed.
Yeah, public house, 2 p.m., 400 North State Street. Everyone's welcome. Looking forward to seeing you guys there. Big thanks to Rob. Make sure you stick around to listen to his After Hours. And a big thanks to Lena and Luke, who both helped out with the editing this week. And
Yeah,
Patrick,
that was good the way Luke jumped in there. Right?
Well, because he saved me, because you just let me flounder on my own always. So anyways, Patrick, why don't you tell people where they can find you?
You can follow me on Twitter at Patrick Ceresna, or you can go to bigpicturetrading.com. And how about where they can find you, Kev?
I'm at Kevin Muir or themacrotourist.com. And thanks for the great show, and we'll see you guys later.
All right, perfect. Well, thanks, everyone, and we'll see you all next week.
Hey, joining us now in the After Hours is Rob Koyfman. Rob, we were having a little chat before the show about New York versus London, because you did spend a little time in London.
Yeah.
And you didn't think you weren't quite a fan.
I wasn't a fan. Man.
A fan of what, though?
A fan of London.
London.
But you know what? He's a typical American. You got to listen to why he wasn't a fan. He couldn't Uber Eats his food at 12 o'clock on a Tuesday. I should tell your story before you. Why don't you tell us why you didn't like? Why you think New York is a better city?
Did you guys live in London before?
No, I've never. You know what? I've been.
I go drinking there, but that's it.
Got it. Okay. So I graduated college. I'm in New York for 5 years. New York is great, especially for someone in their 20s. It's like you have a lot of different people in one place. It's also just you have these like doorman buildings where everything's like taken care of. You could just get packages delivered there, and you could order food at whatever time at night and whatever it is. London is like New York in the 1850s. All these Victorian homes. It's like you're walking up the 4 flights of stairs. Your bathroom sink has like hot and cold on separate things. You have to like combine them together in the little faucet to like wash your face, and it's just like super inconvenient. Everything closes at 11 o'clock because that's just how London is, especially the pubs. Like they do not let people drink past 11, or else everyone would have alcohol.
Yeah, because they start at 2. That's the point, though.
They start at 2, which is the craziest thing in the world. You're coming back from lunch, and all the pubs are filled with people who aren't going back to work, who are just staying there. You definitely, I never noticed this. Maybe I was kind of like young, but in New York, you don't feel this kind of class separation. In London, you definitely feel it a lot more in terms of like cliques you're part of, and the like going out scene there is more of like these members clubs. You have to be part of you have to be a member of a club to get in somewhere, which I was like,
yeah, this
is like really weird. And it really matters where you went to school, and it really matters how you pronounce your R's and your H's and your E's.
For sure, because they'll look at your accent.
They'll look at your.
I have a story to tell you. Let me just interject quickly with my story. And I love London. Actually, I'm a huge fan. I would love to live there, and I love the British. I love their sense of humor, but there's no doubt about it that they are classist at times. And I experienced this when I was a young man and a young kid. Actually, I was a teenager, and we went to England to play squash. And I know you're probably going, "What a d-bag he went to! He was playing squash." You're already kind of judging me, but don't judge me. So we went to. So we were at Eton. Now Eton is the school. It's like where kings went to where the kings go to school. It's the kind of boarding school of the UK. And we were there, and we were spending the night in the dorm with everybody. And I was introducing myself, and someone said, well, hi, I'm, Charles, blah, blah, blah. What's your name? And I said, my name is Kevin Muir. And they said, oh. And I said, what? And he says, don't tell anyone your name is Kevin. And I said, why? And he says, that's an Irish working class name.
Oh my God.
So they were still like, basically because my name was Kevin, they were looking down on me. So I hear you.
But I look down on you because your name is Kevin as well.
Come on, all the Kevins out there, get a rally behind me. I do like them though, because I find them very the English, their dry sense of humor is very fun. It's kind of more, maybe we as Canadians
I
are
have
more
I have
used to
great
them.
time in London all the time.
Yeah, definitely.
It's a great place to visit anyway.
For sure.
And by the way, I loved my time in London. I'm glad I did it. But like there's so many benefits to it. So the thing people told me is you're gonna hate the weather, and I thought the weather was actually better than people made it out to be. It wasn't that bad. It rains like a little more than New York. And people said you're gonna hate the food, and I love the food there. I think there's a lot of really cool Indian and Middle Eastern influence in London. So I actually really like the food there. And you get to travel anywhere in Europe. It's like $45 on the EasyJet to like anywhere in Europe, which is amazing. But in terms of like, did I prefer New York or London? Definitely preferred New York for the reasons I sort of stated before. But London is really cool city. A lot of good things going forward as well.
Nice.
There we go. You fixed it all up, Rob. It's
Yeah,
okay.
I don't want to
insult all sorts of things all the time. Don't worry about it.
Yeah, you're gonna cut that.
And you know what? No Londoner will think any different. They'll be like, "Of course he said that. He's a New Yorker." They think that that's the center of the universe. Like and the New Yorker will be like, "Of course we think that. It is the center of the universe."
It sure is. It definitely is.
There we go. See.
And so,
okay.
So I want to circle back here because you made a statement saying that your Squiggles were better than my Squiggles, and I won't deny that you must be.
Said pardon?
I said pardon. No, but so we actually Rob was doing a webinar for the CMT for the technical analysis. The association there, and I was doing one just a couple weeks after him, so I think we'll have to circle back and see which one had more views. No, just kidding. But
so Rob,
but,
you practice the dark magic as well. You're a CMT as well.
That's where I was going to get to.
Oh, sorry, I didn't mean to step all over you.
Yeah.
And I'm not a CMT, but I do have my CFA.
So you see, he's not a dark magic guy, Patrick. He's not.
I like technicals. I'm a huge, technicals big part of my process, but I just never got the exam.
That's right. But what were you presenting when you were on there? Were you just doing some of the cool shit that you were doing on your platform for the webinar?
It was basically trying to demystify fundamentals and showing examples of how technical analysts can use fundamentals to enhance the process.
So Patrick, he was trying to tell the dark magic guys that they shouldn't use so much dark magic and they should go use fundamentals.
Well, there was a MACD crossover on the PE ratio rising on this. No, but so Rob, what kind of stuff were you showing them?
No, so I think it's like it's funny because like technical people think like fundamental people are just out of their mind, have no idea what they're talking about, and like they're always wrong about targets and estimates and everything they say, and then fundamental people are just like, are you like fucking serious? Like you're looking at a chart and then historically the price is going to tell me what's going to happen in the future. You are out of your mind. And I think there's a misunderstanding about both fields from the other.
Yeah.
And I think they're just looking at the truth in a different way. Technicals is all about history. It's all about looking historically, and really it's about identifying momentum and changes in momentum. And there's a very overwhelming evidence that momentum is a very effective factor. That things that are going up continue to go up, and things that go down continue to go down. And that's been proven across asset classes, and it's undeniable fact of just
the irony of what you just described, though, is the third school, which is behavioral finance, that actually is the linkage between the two, right? Like in the end, what happens is that from human nature, a lot of investors chase the things that are working. Because that's where they perceive the returns being, and they want to own the stuff where the money's being made, and so it becomes like a self-fulfilling feedback loop that basically the faster something goes up, the more it becomes to everyone's attention, and the more everyone wants those same returns, and then therefore more money flow comes into that area, driving the price higher. And it has absolutely has nothing to do with fundamentals, because obviously many times fundamentals are the backdrop from which the buying started in the first place. But it's that is what technicians try to observe curve, but it is very behavioral, isn't it, in terms of how it comes around?
Yeah, so I think that's a great point in terms of like why does momentum work, and is it a behavioral thing? So that this is something that I've thought about a lot, and I've never really been able to convince myself of the reason. I think what you pointed out, this kind of fear of missing out, human nature, chasing returns, is definitely a part of it. I think there's an element of reflexivity here, which is something that Soros talked about, which is like if a company is going up, well, not only is the stock price going up, but it's actually going to impact fundamentals because the company can now hire better employees. It can now raise capital at a cheaper level. So the actual price impacts the fundamentals, and then the fundamentals impact the price, and you have this reflexivity cycle. So I think there's a bunch of elements that go into why momentum works. But it's undeniable in terms of scientific literature and backtesting that momentum is a very strong backward-looking factor. Now, the thing that I think technical analysts miss about fundamentals is that fundamentals work as well. It's just that fundamentals work on a forward-looking basis. So if you look at a forward-looking fundamental, meaning like you can predict the future of fundamentals, you'll do a really, really good job of finding stocks or finding things that work and don't work. The challenge is that a lot of people, when they look at fundamentals, they'll look at historical fundamentals and then pick stocks based on that, which is not the way that works. Again, the future fundamentals is what drives stock price, and as a fundamental analyst, it's your job to predict the future fundamental, whether revenue will continue to go up or whether earnings are going to continue to decline or whatever it is. And I think that's what most technical people miss about fundamentals in terms of that forward-looking challenge of the job.
Well, I would, to contribute to that, I don't think I actually disagree with anything you said, because I think you're bang on. But, fundamentals in my mind, it's hard to justify that there could be a technical uptrend that sees a legitimate and sustained move if it doesn't have the right fundamental backdrop behind it. I think the two sort of often go hand in hand, unless, of course, it's Bitcoin. But but that's a whole different story. But obviously, I think that often the best technical trends often are accompanied by great fundamental stories. Do you think that's that makes sense that way?
Absolutely, and the two have to agree with each other. So it's very rare that technicals will look one way, and then fundamentals will disagree. And actually, when that happens, that presents a pretty interesting opportunity. Doesn't mean that one is always wrong. It doesn't mean that like when the two disagree, technicals are always right or fundamentals are always right. But I think eventually they have to converge, and when the two diverge, it actually presents a pretty interesting opportunity. And that was one of the things that I tried to talk about is when the technicals will give you a much earlier signal of something happening than fundamentals. And so one way to marry the two is to look out where technicals look attractive or start looking attractive, and where fundamentals are at an extreme or at a potential turning point. And the technicals will, because they're real time and they're everyday, will give you a sign or will tell you when that's happening on a much more higher frequency basis than actually waiting for the company to report or waiting for analysts to lower estimates or whatever it is.
Yeah. What do you think of that, Kev? No comment?
No,
you're laying low?
No, I don't disagree. You know what? As much as I kind of give you guys, the Squiggle guys, a hard time, you know me. I'm actually more of a Squiggle. No, listen, Patrick. I don't like assigning the same sort of certainty to chart formations as you guys do. So when I sit there, and if you told me that, if we get a situation where this is overbought by this amount and blah, 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 and a whole bunch of things, then I understand that there are definitely technical kind of backdrops that skew the trade in your favor. Where I have trouble is when people draw lines and go, this has got to hold. There's no way this is going to not hold. And then what happens is inevitably the more people that believe that, the more likely it is that it's going to go above that line, suck everybody in, and then go right back down.
Right.
And I just think that the market is much more complicated than what a lot of times that kind of simple trend line, drawing. And I'm not kind of shitting over it, saying that it doesn't work. And I think that Paul Tudor Jones is the first one to say you got to marry them both. And I would never, in a heartbeat, like never in a million years, would I go and say you shouldn't look at charts, you shouldn't go look at that, you should just ignore the things and go look at fundamentals only, because that's a fast way to the poorhouse. Like at the end of the day, you have to do risk management, and risk management is often helped through technicals. I just have trouble when it's only technicals and when people don't really understand the risk, and when they're just drawing lines and it's just simple drawing lines. But there's lots of guys out there that are doing very sophisticated technical analysis that I actually am a huge fan of.
Right. Well, the one thing I would say is like just because something is fundamentally cheap doesn't mean anyone else gives a shit. I mean,
no,
the real
I agree.
money,
But that's back to your point.
The money is that identifying when everyone else gives a shit, right?
Yeah, but that's back to Rob's point about momentum actually being what you should be looking for. And if you told me I'm doing a screen for cheap stocks that are all of a sudden have momentum, and if you called that technical analysis, I would be like, I'm all for it. Like I'm 100% behind that. Because what's happening is the technicals are showing ahead of time that all of a sudden it matters. For whatever reason, it's mattering.
Yeah, you just when everyone else gives a shit.
Yeah.
And Kevin, I love your point in terms of like sizing and because that's like if you draw a line and you say the market can't go below that, you're not doing technical analysis, because technical analysis is listening to the market. So it's trying to understand if it does go below that, what does that mean for this asset or this stock, and what are the implications for other things. And I think people there's a lot of bullshit in technical analysis, and I think people draw these lines. Like when we were looking at XLU, if you kind of like take that and like, oh, I think XLU is definitely going to do this. Like I'm not sure if that's the right way to look at it, but I think kind of like when we look at it, XLU is in an uptrend. That's like that's just, and that's what we could say right now. If it breaks that uptrend, then we need to reassess like what's going on and how much downside, and is it being supported by other things. Like one of the, when we looked at that gold chart, it's really interesting. Super powerful technicals for gold and gold miners. But then if you look at the dollar isn't doing anything, right? And so that's kind of like it's an interesting then discussion and thought process of two assets that should be related, one with very positive momentum and technicals, and then the dollar like saying like, I don't really care about this, and that kind of like leads to some thinking and understanding of why that's going on.
I wonder how much of this is the Ray Dalio effect. Like it was just a couple of days ago that he started plugging gold in his most recent piece. I wonder how much of that is investors chasing his big recommendation. But who knows? Sometimes big players like that throwing a headline like that out there can influence the liquidity, right?
Yeah, absolutely.
Yeah. Oh, anyway. What else?
So we got to tell us, you have some stories about kind of interactions when you've gone into the business of running a website.
Oh yeah.
Or like you got some good stories for us on that side?
What are some of the craziest stories from some of these members that come in and try out your website?
We get such like because we just have like a contact us on our website, and so we get the craziest requests for data, like these esoteric things that I've never heard of. People just people being dicks and just like, hey, like I want this, and why isn't this here? I'm like, it's a free website, like relax. But it's like being very aggressive about it, not like we the reason we have it there is for requests, but people just being very rude and kind of just like, well, why isn't this futures data real time? Like, I'm not going to use your website. And I'm like, cool, don't use our website. But my favorite story from our users is I send out email updates in terms of like our product and what we're introducing. So if we build something, if we like introduce global yields, I'll send out an email that we've just introduced global yields. And my email is open, so people could just respond to that email and be like, hey, whatever, give some feedback. So we sent, I don't know if you guys have, like on April 1st and April Fool's Day, we sent out a April Fool's email. So like some companies do this, they'll send out an email. And so my email was like, hey, we have this new feature. We basically use the AI and machine learning to really train our algorithm, and it predicts stock prices with a 99% confidence interval. We hope to get it to 100%, but really excited about this new feature. Here's the link. And when you clicked on the link, it took you to the Wikipedia page of April Fools. Like what is April Fools? And one of the people responded just like, hey, the link doesn't work. It takes me to some Wikipedia article. Can you send me the link of the function?
I'm really interested in your system. It sounds good.
That was like my favorite. I was like, oh man, you completely missed the point of that story.
Oh, that's funny. It's also funny that guys phone you up or send you notes and give you a hard time because this free site doesn't have something.
Yeah.
Like it's just shocking to me.
It's not free enough.
Yeah.
I get the same thing with my macro tourists. Like guys phone me up and they want or email me and they want to fight about like my market views, and I'm like, fine, go do the other side of my trade if you think I'm such an idiot. Like, I don't care. I have no skin in the game to try to convince you that this is something you should do. I'm just telling you what I do, and I'm offering it for free. And if you disagree, so be it. And I'm kind of flabbergasted at the
because people take it personally,
but
like
why,
at least
though?
some people do. I don't know. They don't have enough beers with us on the Huddle.
Yeah, I don't get it.
Our Huddle listeners are the best, aren't they? Like
for sure. Well, you know what? We've learned the secret, Rob, to having all sorts of different listeners is that if Patrick and I disagree, we know that at least we're like somebody.
50% of the people
they
will
agree with
like one
of us. So, sometimes they think I'm an asshole, and then sometimes they think Patrick's an asshole, and they just kind of go around, and they're like, oh, this week Kevin's an asshole. Oh, this next week Patrick's an asshole.
I love it.
Although we do have problems right now because we're both bearish.
What?
I know. We should actually talk about this.
You're fucking it up for me, dude.
That's why you're having me on. That's why you're having me on.
Are you bullish?
Yeah, he's bullish. Yeah, he's bullish.
Like you think we still go higher? Like you buy this? You're in my old camp. There's nothing that's worrying you.
I mean, there's always a lot of things that's worrying me, but I think
okay, but like there's nothing that's changed you recently.
No, the evidence is that we're heading higher.
So I'll tell you what scares me is the fact that like when I used to say that, everyone would tell me how wrong I am, and lately people have been telling me I'm right. And I saw Mike Novogratz.
Like, ultimate fucking contrarian.
Yeah.
Okay, Rob, you know what? Listen, if the moment everyone agrees with Kev, he is so uncomfortable. Like he starts scratching his skin and he gets nervous and he gets the sweats and like why does everyone agree with me? This is something wrong. Like he's only ever comfortable when he's like fucking doing the opposite of everyone else. And as soon as everyone jumps on and says you're right, then he's fucking nervous.
Okay, but you have to agree that when Mike Novogratz sent out his tweet about how great the S&P looked, it
marked the top.
It's kind of stalled, right?
Yeah.
That guy's definitely a contrarian indicator historically, but I don't know. I agree with him now.
He's usually wrong, except this time when he agrees with me.
Yeah, exactly. Even a broken clock is right?
Yeah. Twice a day.
Oh. Yeah, you know what? I had a Twitter follower say something to the effect that if Kevin saw it raining outside, he would not take the umbrella because only sheeps would take the umbrella and assume that it's going to continue raining the whole day. And you know what the funniest thing about this story is? That I'm from Winnipeg. I'm from the prairies. And we don't use them. Well, at least I didn't grow up using umbrellas, so I actually hate them, and I don't use them ever, and I just kind of suck it up. And I'm always complaining, and I never use umbrellas. And the fellows at work are always like, why don't you put an umbrella? And I go, I don't know. Umbrellas are just kind of something like, other people do. I'm not going to do an umbrella. And I'm always like just soaked. And I'm so stupid. And so this fellow wrote this on Twitter, I said, little does he know how right he actually is.
Oh, my God.
Okay, you got to tell us some more Caxton and stories. Like, so what was it like working at the big shop? Like, so for people that don't know, Caxton is one of the largest hedge funds around. I guess Bruce was featured in Market Wizards, and he's right up there in terms of for firms. Like, he doesn't have as high profile in terms of being in the news, but in terms of in the hedge fund community, it's right up there with Soros's firm and all the other kind of Julian Robertson and all the like. He's just one of the greatest shops ever. So what was it like working there?
It was awesome. It was an awesome experience. I think I was like I was probably a little too young to really appreciate it. I joined there when I was 26, and I'd never. It was one of my first buy side jobs, and I was dealing with a bunch of senior macro analysts trying to tell them what equities were implying and doing and coming up with equity ideas. But it was really, it was a really great learning experience. I think the other thing about macro, what it taught me is, I always thought macro was like these economists sitting in a room and really predicting like what GDP growth will be and stuff like that. And macro people are just the most ruthless traders and really just trying to make short-term trades and really take advantage of dislocations. I think these kind of like tail trades, these like the 2008 trade or the Bank of England trade that Soros did, that's definitely part of the macro lore. But I think just in general, day to day, these guys are just really, really day trading and really trying to figure out how to make pennies and dimes every day rather than really kind of like living and really trying to predict the economy and model future interest rates and stuff like that. So that was my experience.
So that was your big surprise, was the fact that there's a lot more just grinding trading going on, taking advantage of market structure and flows and stuff, as opposed to making big, huge bets in terms of where GDP or where a currency is going to head for the next year.
Yeah. That maybe that was just like my own ignorance, but I just macro just thought like these big macro views, and I think macro people definitely have views, but they're not going to sit on a trade and be wrong and have the trade go against them and say, hey, I'm wrong or I'm losing money, but I think this will work. They're very, very focused on tactical short-term opportunities and really making sure to size the trade correctly. I think that was kind of like the biggest thing that I learned and was surprised about.
And they're a big fund. Did they have trouble getting the liquidity that they needed? Like, did you find like them struggling and being bigger than the market a lot of times when they wanted to execute trades?
No, because they deal with such liquid assets, and they're dealing with bonds and rates and FX and futures. Even with equities, when we were doing equities, we would build these baskets. So we would represent a theme and build a basket of stocks to trade that theme. So it would be spread out among 20 or 30 stocks. And when we were doing this work, we always had liquidity in mind. So we would exclude stocks with thin liquidity. But I'd say the benefit of dealing with these macro instruments is that the liquidity is super deep. Particularly in the rates and FX market.
Fair enough. That's interesting. Yeah. Okay, well, you know what? We'll call it a night, and we'll let you get on, Rob. Why don't you kind of give us one last plug of where people can find you and where they can sign up for your great product, the free charts. And don't phone them up and yell at them and tell them that it's missing real-time quotes and stuff. No soup for you if you find that, So why don't you give us a little bit of one last kind of overview?
Plug.
Yeah. So in our defense, we do have real-time equity prices for U.S. stocks. So we do have that. But when people start asking for like real-time futures, which cost like $80 per person that we would have to pay the exchange, we can't provide that for free, unfortunately. So the website is koyfman.com. Please go check it out, create a free username, start using it, and hopefully it'll help your investment process.
Great. Well, thanks again. Thanks for being with us, Rob.
Thanks, Rob.
Thanks so much, Patrick. Thanks, Kevin. Great to be here.
So which picture You see, I think that Kevin looks like a great old man. See, though for me, I do look better.
You
as
look
an
like
old
a
man.
great old lady.
Yes.
You know, Patrick, you look like a young Michael Caine, but when you put these
Somehow,
face
like,
tabs-
you don't look feminine on the left, but on the right, you kind of look a little feminine.
Oh my
Not that
God.
there's anything wrong with it, but it's just.
Oh yeah.
Yeah. Don't you think? Like, I'm telling you, you're gonna drive a Subaru. That's it. So, Lena, what do you think about our Cowbell Brewing, Boxing and Brewing craft beer that rings true, India Pale Ale?
I would give it probably 8.6.
Oh, okay, now there we go. No longer a rookie score. I like it. First of all, Patrick, what do you think?
8.
Oh, God, there's Patrick.
Point.
Oh, there we go. Point.
0.4.
God, you guys are really, you think you liked it that much? Because I did not like it. I found it too strong.
I loved
really?
it.
Is it too hoppy for you?
Too hoppy, like it's just too hoppy, too strong. It was.
You know what?
fine.
If I needed to get wrecked, I would take this as a sessionable beer.
you would drink sours if you
No.
wanted to get
No. You can't get wrecked on sours. I enjoy some sours, but this is a sessionable pale ale that is strong, so you can get like properly drunk on this for sure.
Well, I don't know. I'm a little more sophisticated, Patrick. I don't just drink my beers to get wrecked. I found this just. I guess you're right, Lena. I thought it was a little too hoppy, and I found that little. I don't want to taste alcohol. And I found that whenever these strong ones, I find I get like a little tiny aftertaste of alcohol, which I don't want.
Oh,
and it lingers
Christ.
for a while, doesn't it?
Yeah, like it just doesn't taste like beer when it's like when you get that overwhelming, that just kind of that. Well, it's not overwhelming, but it's just like you definitely know that it's got like more than 5. So maybe I'm a lightweight, Patrick. Maybe I like the 5s, but I just think that anytime I'm tasting that kind of, little bit of like medicine taste, like not medicine, but like the fact that there's alcohol in there, like you just like I'm a seller. So I'm not. Listen, you guys give it 8. I'm going lower. I'm going 7.2. I'm going 7.2.
Go back to that WTF video, that scene where she pukes in her mouth. When you were doing this little routine about the little taste of alcohol, I felt like her.
Okay.
I felt like her.
You know what?
Yeah, well.
For this beer, it also says pairing curry dishes, pizza, wings, and carrot cake.
Yeah, see, what the fuck is that?
Odd.
First of all, I don't like curry. Like I know a lot of people like them. Like probably half the world loves curry. I don't. And then carrot cake. Like who the hell drinks beer with carrot cake?
I just don't eat carrot cake. Period.
No?
I think they're vile.
Come on. Now this we got to talk about. We got to explore. What is wrong with carrot cake? So are you one of these people that hates raisins in?
Oh, I don't eat raisins. That's one thing I will never eat.
What? Like, yeah. So Patrick, my wife and all of her friends are like, they got this aversion to raisins. They think it's disgusting.
Really?
Oh, I think it's so gross.
Yeah. I think it's a male-female thing. She tells me I'm wrong, that males don't like, there's lots of males who don't like raisins. I call bullshit on that. Yeah, I love raisins.
Okay, but
like
in all fairness,
1 second.
I pretty much will eat anything.
Yeah, I'm the same way. But
there isn't one food but you said you just didn't eat curry.
That is the one thing I don't like. But listen, back to raisins. I know, because you eat anything. But
I'll eat anything.
back to raisins. Okay, so Lena, you can tell me if this grosses you out. You know that show New Girl?
Yeah.
One of the characters on New Girl, he got a mouthful of raisins and he leaves them in his cheeks. Like he puts them all in his mouth so that they get nice and plump. Like he leaves them like chewing tobacco.
Oh, that's disgusting.
And like my wife.
But you know what? I'm okay with raisins on their own. It's only when I bite into them that I just vomit in my mouth.
I thought this was the funniest thing in the world. I saw that. My wife was saying how gross it is, and I thought to myself, that sounds like a good plan. You know, like when you get a raisin that's a little too dry, Patrick? And it's just like a little too dry, and you just go like,
need it to be a little bit more plump.
Now that you brought up the picture of me, that kind of picture of me on the right, that's like a raisin. That's a little too dry. And You just put it in your cheeks and you hold it there until it gets nice and moist.
I just think it's anything you put in your mouth and you have to hold it there, just gross.
Yeah. Well, anyways. So I'm giving this. What did I give it? 7.2, 7.1. I'm in the sevens for sure.
7 something.
So you guys are.
I actually love this beer. I might actually buy this beer on a regular basis. This is actually delicious. I am. You know what? The sponsor, Lena, this week. The sponsor. It was great that you got Cowbell to come and sponsor us. This is awesome. I love it. Love it.
Actually, while we're doing this, if any Chicago friends wanted to, find a sponsor and give us, half a dozen of a different Chicago beer, we're happy to take kind of American sponsors. And Patrick is driving, so he will be able to smuggle it over the border. We would love to do some Chicago ales, like for sure. Just no sours, which I mean.
Oh, no. What do you mean?
I know. That's going to mean we're going to get sours.
You just asked for it, dude.
Can I have all the sours? Please, everyone send me sours. I love sours. Okay.
Speaking of Chicago, the poll had closed on Twitter.
Yep.
51% of the voters are siding with Kevin. So how do you feel about that?
I feel bad because actually I wanted to be the underdog. And to be fair, Patrick knew I wanted to be the underdog, and he voted for me like numerous times.
I
with all
did.
his fake
That's the 1% right there.
That's not
and more
fair.
Well, you know what the problem is? I told him that I was voting for Patrick, and because I wanted to be the underdog, and then he made up all these fake accounts and voted for me.
It's not fake accounts. I actually have 3 Twitter accounts that have
Oh,
access
it's only
to.
3. I was going to say, probably the reality is that we probably got, 100 votes, and 98 of them was Patrick voting for me. Not 98.
True.
I couldn't. That's not very good math, but anyways.
Well, definitely, I put you over the top, which I'm happy. Now I get to be the underdog going into this. I have less stress on me.
But you know what, Patrick? You are far from the underdog because, as we know, when we're looking at all the kind of narrative out there, you are in esteemed company, Patrick Ceresna.
Oh, my God.
James Rickard.
Yeah.
Kyle Bass. And Patrick Ceresna. All think rates going to 0. All have a narrative.
I mean, even Ray Dalio's in my camp, isn't he?
I don't know.
Yeah.
I'm not sure. I didn't read the stuff. Everyone's been telling me I gotta go read the thing and stuff. I haven't read it yet. Did you read it?
Yeah.
Okay. Well. Anyways, we're getting we're struggling.
All right,
to talk about
done.
now.
Listen, looking forward to seeing all of our listeners out in Chicago that can make it because that's gonna be an awesome time, buddy.
It should be good.
And we're gonna have a great time doing the Bull Bear debate with John Netto, and then it's just gonna be drinking for the rest of the Sunday. That's gonna be awesome.
Yeah, and I have to get up Monday morning and fly real early, so it's gonna be really great.
All right.
Okay, well, anyways, Patrick, I look forward to seeing you Saturday night. I will see you, Patrick. You are headed early, and you're going to be on the town in Chicago, but I will see you Saturday night, and then Sunday for our big debate. Looking forward to it.
All right.
And
we'll
Lena,
that's
right. And Lena, I'm sorry that you can't be joining us. We'll make sure you join us for the next one.
Yeah, I'm so sorry.
I know.
We're going to have one in Toronto soon, right?
No,
you know what?
Patrick, he's
no,
a
but
cheap bugger.
Listen. No, but...
Let's face it, that's right.
Hey, stop. But in Toronto, in September is the Money Show in Toronto, which we can do something there, and we're gonna do. There's an options education day as well. Like we'll do some sort of a huddle meetup in September, and we'll do it locally in Toronto. And Lena will.
And Lena can come, and she'll drink you under the table, Patrick.
Of course she will.
Okay.
And then Luke will drive her home. All right.
Okay.
All right.
Have a great weekend, everyone.
Yeah. Cheers, everyone.
Thanks. Bye-bye.
Bye-bye.